Good evening. What is the last discussion? GST. Okay. So, how is GST 1 different from GST 2? That is what is the discussion, right? So, one is we already know why GST, what is the purpose of introducing GST, and what GST has done in terms of revenue increase and things like that. So, can anybody tell me what could have been the problems in GST 1 so that we'll understand what they have done with GST 2? What are the problems in GST 1? Okay, so one, as you're mentioning, there are multiple slabs. Okay, so earlier slabs we had this 0, then 5, and 12, 18, 28, and gold in 3%. Okay, so these are multiple slabs. So one nation, one tax, one rate was suggested. One rate was not possible because Arun Jaitley wanted to make it artificially progressive. This is called as tax democracy. Okay, so tax democracy is poor people purchase more items here, let them pay lower taxes, and richer classes, when they're buying something in the 28%, let them pay more. So it is trying to make regressive taxes artificially progressive. That was what was called as tax democracy. So who will decide these slabs? These slabs are decided by council. And GST council will also decide the threshold limits. Like somebody whose turnover is above 40 lakhs, now you have to apply for GST. Who's going to decide that? That is also decided by GST council. Okay, so which item will fall where? Everything is decided by GST council only. Okay, so this is one aspect. So in the new rate structure, you have the prime base rate, if you observe. So you have the 5 and 18. That's it. Okay, and then you have the exempted list, necessities which are in the 0, and demerit goods. Demerit goods. These are basically in the 40% slab. Okay, so a lot of changes were brought in by government in the sense that GST council, many things which were in the 12% slab earlier were pushed into 5% slab. Earlier they were processed foods, etc. All these were in 12% slab, they were pushed into 5. Okay, similarly, air conditioners or washing machines and these kind of items which are in 28%, they have brought it to 18%. And few important necessaries like life insurance, health insurance, they were pushed from 18 to 0. These are reforms basically. So what is the benefit of all this? One is it will reduce cost push inflation. It will reduce cost push inflation, reduce. So when it's reducing cost push inflation, prices of the products are going to come down. Then our monetary policy can focus more on GDP growth. That means they can go ahead with expansionary monetary policy without worrying much about inflation. So it gives right signals for the monetary policy. This is for that. This is one important observation. Now, one more problem in GST is the problem of inverted duty structure. This is also there. This was also addressed in GST 2.0. So some words which you know, then we'll get to the document. So inverted duty structure, anybody wants to try? Finished goods. Okay, good. So in simple words, this, of course, inverted duty structure can be understood as far as GST is concerned or as a regular concept. What is the problem in India? See, whenever we are importing some raw materials from outside, suppose I'm manufacturing this pen, and to manufacture this pen, I need some raw materials like the plastic and whatever. So when I'm importing these raw materials from outside, the taxes on raw materials were too high. But if I'm importing the finished good, that is the pen is the finished good. If I'm importing the finished good, the tax rates were less. So what will happen if that is the case? You will import the finished good rather than importing raw materials to produce something, as simple as that, right? So this will discourage what? Domestic manufacturing. So there are some duties that are mentioned: anti-dumping, safeguard duty, countervailing duty, that is mentioned, anyhow, that will come. Okay, so I'll talk about that, but before that, I think this is clear. So what is the problem here? The problem is it will discourage domestic manufacture. I don't want to manufacture pen within India no anymore. Why? Because if I manufacture pen in India, then it is costing me more because raw materials are. So I directly import. This is what is it inversion. This is duty inversion. If you want to encourage manufacturing, it should be the other way around. What is the other way around? Raw materials, taxes on raw materials should be less, so that you will import and produce. But there's a duty inversion here. I hope it is clear. But when it comes to GST, what is inverted duty? Everybody's understood this? No. Okay. So when it comes to GST, inverted duty structure is something like, in GST runs in the similar manner as my VAT, value added tax. Simple logic. Okay. So now we'll not calculate here because we don't have time. Okay. But one important observation is GST is, whatever tax I pay on inputs will be refunded back to me on my outputs. As simple as that. For example, any business, any company, let's say I'm running a small company, I'm buying raw materials in Amazon business. I'm buying this laptop and this and chairs and everything. Okay, I'll pay GST on that. Okay, and similarly, I'm collecting GST from the customers. Let's say you are the customer or the consumer. I'm collecting GST. Now I have to file this GST on my output to the government. When I'm filing this GST on my output to the government, whatever taxes GST I paid on my inputs would be subtracted from my output, and I'll be paying tax on my value addition. This is what happens. Everybody's understood this. Simple understanding is, let's say coaching is 18% slab. Okay, and every academy which is collecting GST has to pay it to the government. Same applies to manufacturing also. Similarly, the business has to procure some raw materials for running the business. The business is going to pay some GST. So when I file my GSTs every month on my output, okay, so when I pay this collected GST to the government, whatever GST I paid on my inputs will be subtracted by the system itself. The GST network subtracts this, and my tax liability is clearly mentioned in the portal. That's how you pay your GST. As simple as that. But there is a problem here. Certain items, for example, certain inputs like cement, etc., the tax rate was very high. Inputs. Okay, so that means if the GST on inputs is very high in comparison to outputs. Okay, what is this? This is what is called as inverted duty structure in GST. Suppose a construction unit or a builder is constructing some apartment or whatever. There are cement costs, etc. On cement, if the GST is too high, these are raw materials. These are raw materials. Raw materials. On raw materials, GST is too high. What is the problem? My working capital is getting blocked here. Working capital is getting blocked. Are you able to get this? So this is a problem because this is nothing but inverted duty structure in GST. Inverted duty structure is the taxes on inputs or raw materials, especially like cement, like entities, is high in comparison to the output. The problem for the entity which is doing this business is their day-to-day running of the business, the working capital is getting stuck here. So in the GST 2.0, they have reduced taxes on such raw materials. They've changed the slabs for such raw materials like cement, etc. They've done that. Is that okay, everybody? So this is also one more important reform which they have brought. Okay. Then for MSMEs, they said within 60 days, refund should be given. Why? Because MSMEs, one problem for micro, small and medium enterprises is they have very less working capital. Their cash flows are stuck. Then there is a problem for them. So 60-day return, pre-filed return. The pre-filed means already the data is already filled in. You just need to update. Invoice matching mechanism. Invoice matching is a new one in GST 2.0. If you open the GST portal, there is invoice matching. So immediately the invoice would be matched and checked whether the filing is done appropriately or not. So both the parties have to file it perfectly. Otherwise, there will be a trouble with respect to GST credit you get. If the other party is not filing it properly, then you will not get your credit. So therefore, you'll ask that fellow file it properly and match the invoices. So there is an auto invoice matching mechanism which they have brought in the software in the GST 2.0. Are you able to get this? Okay. So these are some of the important changes. And madam talks about, yes, we have done see, GST 1 is very good. Of course, I'm not talking from the main perspective here. We don't have that time. So GST led to formalization, 2 lakh crores, new registrants were there initially itself. All that is there with respect to GST. All those benefits were there. But here, if you see, 101st Constitutional Amendment led to implementation of GST. We have come up with a dual GST system, and that is both SGST and CGST will be applied together. Whenever there is interstate trade, there is something called as IGST. We have come up with destination-based GST model. And therefore, because of this destination-based GST model, there was one problem here. Okay, so okay, heard of this word? So yesterday we mentioned that this word called cess. Okay, but GST compensation cess is also based on Act. Okay, so now how does this function now? Anybody? So why this GST compensation cess? Because it's a destination-based tax. So in simple logic here, if there is an interstate trade that is happening, this is Arunachal, interstate trade, you're selling a car from here. So currently what will happen? There will be IGST that is going to be levied. Who levies IGST? Center. Okay, as per Article 269A. Okay. So the power to levy IGST is with center. Center levies it. Let's say center has collected 5,000 rupees. Just an example. Okay, 2,500 the CGST portion. See, IGST is nothing but CGST plus SGST, right? So 5% IGST is levied by the center, and 2,500 is going to the center. Another 2,500 goes to the destination state, that is Arunachal Pradesh. So earlier the situation was a little different. Earlier, as per Article 269, there used to be CST that was levied, Central Sales Tax. This is levied by center, but the revenues were given to the exporter state, that was Maharashtra. So earlier revenue was coming to Maharashtra. Here Maharashtra is not getting revenues. So obviously states like Maharashtra, Haryana, Gujarat, Karnataka, manufacturing states like Tamil Nadu, they were like unhappy that revenues earlier, CST revenues were coming, but now it is not coming. So what government said, first 5 years from 2017 onwards, we will try to compensate you. How will we compensate? Suppose your tax revenues are not increasing at a rate of 14%. Tax revenues year after year should increase at a rate of 14%. If they are not increasing at a rate of 14%, whatever is missing, we will try to compensate you by levying something called as GST compensation cess. And this was not levied on every item. It was primarily levied on sin goods, tobacco-related items, and also certain high-end automobiles. And that revenue has to be given to the states to compensate them. So after 5 years, during COVID period, one trouble came up. The trouble during COVID was they were not in a position to, center said, we don't have cash. But states forced the center, no, you told you will give us, you have to give. So what center did, center borrowed from outside and started giving compensation cess. This is what has happened. So now after 5 years is over also, GST compensation cess is extended to another 5 years. But still, revenues are not given to the states now. Revenues, there's no confirmed decision with respect to revenue sharing. They're saying, so whatever loans we have taken earlier to pay you, for those interest payments, right now, whatever GST compensation cess we are collecting, we will use that money for paying back that particular loan which we have taken. So now currently, though compensation cess is there, the transfer of money is not being done. So center's logic is very clear. We are next 5 years also will do it. We'll levy compensation cess on certain demerit goods. But at the same time, we will not transfer the money to the states. But states are asking for it. I think it is clear. Okay. So that 14% logic does not exist now because you're not giving. But that money is used by center. Right now, center is saying we will give that money. We will pay back the loans which we have already taken. Is that okay? So in simple understanding, compensation cess, is it there? Yes, it is there. Okay. Is it there on all items? No. So like every other cess, it has to be spent for the purpose. The purpose here is very clear. The purpose is you have to primarily use it for compensating the states. But right now, first 5 years they have done that. But during COVID, since our FD touched almost like 9.2% during COVID, you had to borrow a lot. And for paying states also, center did not have cash because GST was not coming that point of time. Okay, so to compensate states, then they borrowed money from outside. So the borrowed money you have to pay back. So for that we are collecting compensation cess. Okay, so now see here, GST 2.02 slab system, 5% 18, removing the earlier 12 and 28. Okay, and 40% special rate that is there, replacing the compensation cess levy. So compensation cess now has reduced almost like, though, but center is saying will not pay you. Okay, so then the median tax rate, effectively has moved from 12% to 5% now. So earlier 12% was the base. So now it is 5% and you have the 18%, 5 and 18. Okay, so here there's a lot of relief. One is the exempted list, especially health insurance, etc. You can see here health insurance, life insurance policies being pushed to exempted list. And several life-saving drugs have moved to nil rate. And most other medicines moved from 12% to 5%. What does this indicate? Inclusive growth, simple. Okay, so, and then key economic drivers here. So, as I mentioned, televisions and these kind of items, they were removed from 28% to 18. This is, madam is talking about boosting consumption, C plus I plus G plus NX. When it comes to GDP, anyhow, exports now, there's a lot of trouble in Europe, whatever Trump is doing. So, we don't know how things will unfold. So, obviously, government in the budget will also focus on domestic consumption. Automatically, their focus in the budget, this year's budget also will be on domestic consumption because you're not able to understand what is happening outside. You can't predict what is going to happen. Therefore, the focus will be on domestic consumption. Their logic is very clear. When I bring all these items from 28%, like air conditioners and televisions from 28 to 18, the prices will come down and people will consume, increasing the domestic demand. That is the whole logic there. Okay, then you can see cement drops from 28 to 18. So this is basically what I've explained about inverted duty structure. So they want to reduce the inverted duty structure mechanism in GST. Inputs, always the taxes should be less. Otherwise, my working capital will be blocked. If there is a small builder who is constructing, for him, this 28% cement is a torture because you'll get back this money later only once everything is over and once you file. So the question here is my working capital is getting blocked, especially when the inputs are too expensive. This is one more important. So there is also dispute resolution. It has been formally launched by the government. Okay, Goods and Services Tax Appellate Tribunal is set to be operational for appeals before the end of September 2025, right? And registration ease, this I was talking about, easy registration and also invoice matching, automatic invoice matching and 60-day limit for MSME refund credit. All these are part of this simplified registration and transfers. Okay, and export benefits. Now here, there is something which you should understand. Okay, I'll explain it with a simple example to understand this. See, in GST, we use the word GST is zero rated. Okay, so there are some common principles of GST. Like, for example, let's say, so we say GST is levied on a, one is GST is levied on a common base. Okay, and then exports are zero rated. Okay, so common base, zero rated means what? Anybody? So whenever you're producing something and you're trying to export it, so whatever your exports are, whatever your taxes on your inputs are completely refunded back to you when you're exporting the product. So generally, most of the items, exports are zero rated. That means what? Whenever you're producing something and exporting, if it is treated as an export, whatever tax you have paid on your input would be refunded back to you as input tax credit completely. Okay. So, but there is one problem, especially with respect to certain services, which are called as intermediary services. Certain services which are called as intermediary services. If you try to understand the change here, you can see here, recommended that the place of supply for intermediary services will be determined as per the location of the recipient of such services. Earlier, it was decided by place of supply. Anybody who's understood this line? A little complicated. Anybody who's understood this? See here, it recommended that the place of supply for intermediary services, okay, will be determined as per the location of the recipient of place of supply of the intermediary services will be determined as per the location of the recipient of such services. Earlier, it was decided by the place of supply. For example, let's say that place would be treated. See, suppose there is a software company in Noida, okay, and this software company is acting like an intermediary between clients in US. Client is US, there is a client, okay, and there are some software developers in India. But this software company is only an intermediary service provider. Intermediary service provider means what? He is not going to change anything with respect to service. He's only facilitating the service. He's not going to modify or bring any change with respect to service here. So this software entity which is there, which is an intermediary, that is what is an intermediary. So intermediary services, this software institution which is there between the US client and the software developer in India. Okay, they are called as intermediaries. Are you able to get this? Now, when they are facilitating a transaction, that means now the client has got the service and client has made some payment. When the client is making some payment here, this entity is receiving it in dollars, obviously, in foreign currency, basically. So when you're getting some dollars out here, basically it should be treated as an export. As simple as that. So when I treat it as an export, then exports are zero rated. What does that mean? Zero rated means whatever inputs that company uses for this export should be refunded back to the company. But what is the problem earlier? The problem here is, if you see, recommended that the place of supply for intermediary services, the place of supply will be determined as per the location of the recipient. Here the recipient is the US client, is the recipient of service, okay, of such service. Earlier it was the place of supply. Place of supply means Noida. Are you able to get this? Earlier, this particular transaction, the place of supply for intermediary services, what is the place of supply? Earlier, the place of supply was seen as Noida. Now they are saying place of supply should not be seen as Noida. It should be seen based on the recipient of service. That means it is US. If it is US, it becomes what? Export. If it becomes export, what will happen? Zero rated. That means your whatever taxes you paid on your inputs, you for this intermediary service provider, he will get it as input tax credit. No, earlier these intermediary service providers were not getting ITC. They had to pay 18% GST. Earlier, when they were receiving this payment, if the place of supply, they're taking the intermediary services based on the place of supply, that means it is not an export, then 18% GST was paid by this software provider. Now this 18% GST is not paid by the software provider because you're treating it as export because of the recipient state. See, it will be determined as per the location of the recipient. That is the meaning. I think it is clear. Okay, so this one, only this one, or you are asking overall? Overall, lot of benefits are there. I'll come to that. Okay. Benefits of GST or benefits of GST 2.0? Intermediary services, see, ultimately in indirect taxes, who will bear the burden? Final consumer. So whenever there is a tax, ultimate burden will be on the final consumer, whoever is the consumer. Are you able to get this? Okay, so ultimately it is the final consumer who has to bear the burden. So obviously when the tax burden is coming down, the final consumer will have lower taxes. This is the benefit. But there is a negative also, not negative, but for example, have you heard of reverse charge? Okay. What is reverse charge? Suppose in a transaction, who pays GST to the government? The supplier of the service. Whoever is the supplier of service, he will collect it from the buyer. Suppose Vision is the supplier of education, then Vision will collect it from the student and Vision has to pay it to the government. Maruti is the supplier of car, Maruti should collect it from the buyer and pay it to the government. Who is paying it to the government? Supplier. Meaning of reverse charge. If the supplier is not in the GST ambit, let's say, then how will the supply chain or the GST move forward? Instead of supplier filing that particular transaction, it will be the buyer who is going to pay it to the government. Straight. Because the supplier is, suppose let's say the supplier does not have a GST number. It's a very small micro enterprise. The supplier does not have a GST number. Or supplier is a farmer. He does not have a GST number. Then what about this transaction? What to do with this transaction? Instead of the supplier, because in that whole supply chain, only one entity does not have GST, let's say. Then how to carry forward the input tax credits to the subsequent entities? So instead of the supplier now, the buyer will file it to the government. This is what is called as reverse charge. So whenever this intermediary service entity is buying some inputs from outside, now it will be treated as inputs, and there now that buyer, that is the software company, has to pay reverse charge. That means that foreign entity is not going to pay GST in India. So now who is going to pay? It is this software company has to pay if he's importing. So when he's importing, then obviously the place would be India now, and therefore this software company has to pay GST to the government using the concept of reverse charge. Why? Because reverse charge means what? Buyer is paying it. Okay, if it is becoming difficult, then leave that reverse charge as of now. But I hope this is clear. Indirect tax incidence impact are at different points ultimately. Impact is what? Ultimately, finally, who's going to pay? Okay, so basically, again, the software company will collect it from somebody. So incidence and impact are always at different points only. Okay, so in that reverse charge also, so if you try to understand reverse charge, the supplier used to collect it from the buyer and pay only. It is not the supplier paying. Supplier is collecting from the buyer. But since the supplier is not in GST ambit, now he's not collecting from the buyer. So buyer automatically pays it. So the liability has not changed. Is that okay? Now, if reverse charge is confusing you, leave that reverse charge, but I think this is clear. So recommended that, so this was also a recommendation. Recommendation is that the place of supply for intermediary services will be determined as per location of the recipient. Earlier it was. So what is the benefit? This will help Indian exporters to claim export benefits. Only then it will be treated as export and that refund will come to him. Intermediary services involve facilitating the supply of goods or services between two parties without altering them. As I mentioned, this software entity is not going to alter anything. It is only facilitator. That is what is the meaning. So that example, if you remember, only then this will be okay. Otherwise, this is like too much of English. Is that okay? Understood? Right. Before we talk about GST 2.0 benefits, of course, GST Council, I think you should be knowing in polity also. So GST Council, this is factual portion. GST Council Article 279A, right? What are the functions of GST Council? One, it decides the slabs. Two, it also decides which item will fall in which slab. It also decides the threshold limit for taking GST. It will also decide threshold limit for composition scheme under GST. There's one more scheme called composition scheme under GST, where you don't pay your GST, you don't file your GST every month, you file it once every 3 months. Okay, this is called as composition scheme. So 1.5 crore, whoever the manufacturing company whose turnover is less than 1.5 crore, they can apply for composition scheme. So who's deciding that composition scheme threshold is 1.5 crore? That is also decided by GST Council only. So all these thresholds are decided by GST Council. And also IGST sharing mechanism, how IGST proceeds will be shared. Currently the way IGST is shared, suppose center is taking certain portion, remaining portion is going to the destination state. Now how 269A says, Article 269A says, the sharing mechanism among states will also be decided by GST Council. That means IGST proceeds, how they are going to be shared, that will also be decided by GST Council. So GST Council decision making is taken based on voting. So if GST 2.0, some states where Congress ruled states were not happy, for example, Telangana said we are losing 7,500 crores every month. Karnataka said we are losing 15,000 crores every month because of your GST 2.0. That means then how did you implement it then? That means without certain states participating also, you can push forward reforms in GST Council. As simple as that. So why? Because states have a vote strength of 2/3, center has 1/3. But overall you need 3/4. You will not get that 3/4 unless and until center approves. But you can get that 3/4 without some of the states not approving. Simple. So very few Congress ruled states are unhappy. There may be others. See, northeastern states are also unhappy. They say that my revenues are coming down because of your GST 2.0. And for us, GST revenues are very critical for developmental aspect. That is their logic. And nothing wrong. Maharashtra losing revenue is okay. But northeastern states losing revenue is very difficult. So both are not at the same level. So these are some issues which are there in GST 2.0. Okay, so issues are also there. They talk about GST 2.0 ensures, obviously GST ensures cooperative federalism. Cooperative federalism through GST Council. So now you're asking, what is the benefit? See, what is the benefit of GST 2.0? So if I have to look at pure benefits, okay, one is which inflation I was talking about, cost push inflation, right? Okay, so prices for the final consumer are going to reduce. Why? Because essential items you have pushed it from 18 to 0 and all that will reduce inflation, etc., etc. All that is what we have discussed. Then they have decided to address this problem of inverted duty structure. That is, the GST on inputs like cement, etc. Okay, so will be lower, so working capital will not be blocked. So these are some things which I mentioned. Then they said tax compliance is going to increase. Tax compliance means easy tax filing. Why? Because earlier you had so many slabs. Now primarily you have 2 slabs only. This is one important observation. Second is there are certain easy refunds, invoice matching, all this for MSME. Are you able to get this? So here one more important observation here. GST 2.0 also clearly mentions that we are formalization. Okay, that is anyhow. This is a benefit which is there even for the GST 1. There's nothing specific. So formalization. Then right signals to monetary policy. Okay. Then this is mainly for mains. Social equity, because you're talking about health insurance and all that, life insurance, life-saving drugs. So not for prelims primarily, but okay. So that will also enhance. Okay. So and not just growth, but they are very clear that it is a combination of both growth plus development. So mains we can write few more, but these are some things. I don't think they'll ask such easy questions. They'll not ask what are the benefits of GST 2.0. But what I think probably they might give some rates and something like that, or they might talk about inverted duty structure, something like that. So, and I don't think they'll ask this. This is also a change. So exports are 0 rated, intermediary services. That is what. Okay, now come back now. That's sufficient, right? Now what is this anti? So there are some more terms mentioned here. Okay, so one is anti-dumping duty. Anti-dumping is, who is in charge of this anti-dumping duty? Which ministry? Commerce? Ministry of Finance. Okay. So anti-dumping duty is levied to prevent dumping, as simple as that. Okay. And what is dumping? You already know what is dumping. If a particular country exports a product at a price that is significantly lower than the price it normally charges in its domestic market. Okay. So that is what is Anti-dumping duty. Okay, so whenever a product is imported, first there is BCD, that is the basic customs duty that is levied, which is outside GST system even today. Okay, so after the basic customs duty, what is levied is additional custom duty or countervailing duty, that is also there. So what is this countervailing duty? This is to counter excess subsidy given by other countries. Countervailing, that means you're trying to counter something. So you're trying to counter what? You're trying to counter excess subsidy given by other countries. For example, recently there's a new steel policy that has come up. Tata Steel and Jindal Steel, they were all happy that government decided to push some import restrictions on foreign steel. Why? Because the globe is not doing well. Demand in countries like China for steel has come down. So therefore, since a lot of demand has come down, a lot of excess supply of steel is there in these countries. And these countries want to push that steel into India at lower prices. This will affect the profitability of such companies like Tata's. So they started negotiating with government. Why they have to negotiate? Because they want to keep their business safe. Because this cheap steel, if it is coming to India, then their steel nobody will buy. And profitability of these companies is going to come down. Okay, so that's not same as dumping. Dumping, only you can say it is dumping provided they're selling a product at a price lower than what they're selling it in their country. So this can be because of the prices in the steel market falling, or this can be because of excess subsidy given by other countries, which we are not giving. Or earlier, what we used to do, see, earlier there used to, whenever we used to produce something in India, there used to be what? Excise. Now today excise is not there, it is part of GST. But excise, let's say, is around 13%. Excise, let's say, it's around 14%. Okay, base is 10%. So somebody who's producing the product in India is ending up paying so much of tax. But somebody who has produced steel outside is not paying this tax. So how do I bring both of them on a similar platform? That you want to offset this excise and bring them on a similar platform. That is also done through countervailing duty. Two purposes of countervailing duty. One, handle excess subsidy. Two, to offset the excise duties paid by the local manufacturer. Then there are some special additional duties also levied. Like if there is something like if there is a trade between two states, or if there is a movement of goods between two states. Earlier there used to be octroi. Of course, now octroi is subsumed into SGST. You don't have octroi is a state domain tax. So now you don't have. So similarly, if there is a sale happening within the state, you have sales tax or VAT. Now you don't have VAT. That is part of SGST. But you need to have, if there is a sale from one country to another, then there should be something similar to these kind of taxes. And that is what is the special additional duty. Over and above all this, if that country is dumping goods, only then we come up with anti-dumping duty. Anti-dumping is not a regular tax. Anti-dumping comes into picture only, and the onus lies on India. If India is levying this duty, we have to prove that dumping has been done by that other country. Otherwise, these countries can go and file cases against us in WTO, saying that unnecessarily you are coming up with anti-dumping duty. I hope it is clear. Okay, so then there's one more word there. You find something like safeguard duty. Is that? Okay, so the safeguard duty is mainly discussed as part of WTO discussions. That means if there is, this is not specific to a specific country. You're not targeting any country. These duties are not to target any country. So it is generally a safeguard under WTO guidelines. So if there is too much of import of certain item moving into India, and let's say these are import sensitive items, for example, rice or wheat, suddenly there's explosion of rice output outside India, wheat output in Australia, and they want to push that product into India. And there's too much of import beyond a certain limit that is moving into India, which is affecting the domestic market, then probably Indian government can take. It's not specific to Australia. It is basically we want to safeguard our domestic market from excess imports that are moving into the country. That is what is basically called as safeguard duty. You can see there safeguard duty. If you see here, it is a form of safeguard measure available to WTO member countries. So this was accepted around even in the Doha discussions were there, then Nairobi discussions in the ministerial conferences of WTO. Okay, so they are imposed to provide a level playing field to domestic players against sudden and significant increase in imports of a product, and that product is generally seen as import sensitive item. So that means import sensitive means if too much of import comes up with respect to that product, then the domestic market will get affected. That is what we mean by import sensitive. Okay, so in principle, safeguard measures cannot be targeted at a particular country. In principle, these measures cannot be targeted at a particular country. It's not country specific. We'll put only safeguard duty when something is coming from Pakistan or China. That you're not going to do. Okay, so here, however, under exceptional circumstances, the imports increase disproportionately. Individual countries' quotas can be applied. So individual country quota is when that's an exceptional situation. Otherwise, safeguard duty is not country specific. A safeguard measure should not last more than 4 years. Okay, then see, general guideline is safeguard measures should not, and so you have to keep on reducing year after year. That is the rule. The rule is 4 years. Year after year, you have to reduce the rates. And if the rate, then you can extend it if you want, due to some other aspect coming up to a maximum of 8 years. But general rule is 4 years, and every year after year, safeguard duty rate should be reduced. This is the meaning. Is that clear? Yesterday, we have talked about FD and primary deficit, gross FD, net primary deficit. Is that okay? Right? Okay. So there are certain borrowings which are done by the government, which are not shown by them in their budget. That is why I use the word called as off budget. Something not shown as part of the budget. So instead of government directly borrowing, maybe there can be an entity which is related to government which is borrowing. And that borrowing is visible on the balance sheet of that particular company. That can be a public sector unit which is borrowing. So as of now, it is not shown as borrowing of the central government. Rather, it is shown as the borrowing of that PSU unit. So that means, but tomorrow this PSU unit is not going to do well, not in a position to pay back. The liability again falls on government only. But this is a one way you can escape from fiscal prudence, in the sense that you are not showing your FDs. Your FDs are low, but if your off-budget borrowings are increasing, it's an indication that there is some trouble. So it's also very important that off-budget borrowings of the government are also very low, along with your FD targets. Otherwise, your FD targets are in line, but your off-budget borrowings are increasing. That's not a good sign, because that is also borrowing at the end of the day. So here, if you see government borrowing that is not explicitly included in the official budget presented to the public or approved by the legislature, that is what is off-budget. These borrowings are typically raised through government-controlled PSUs, government-controlled public sector units, or entities which depend heavily on budgetary support via equity infusions, loans, grants, or subsidies for their operations. Okay, so purpose keeps borrowings off the fiscal deficit books, creating an impression of fiscal prudence. Fiscal prudence means efficient fiscal discipline. You're not spending unnecessarily. So off-budget borrowing will give that, it shows that as if there is fiscal prudence, but no. So it reduces transparency, but at the same time, debt is also going to increase. Is that okay? Yes. Let's move on to the next discussion. See, anti-dumping can only come up when there is dumping. So what is the meaning of dumping? That means our officers should go and check there that the prices that are sold in their country is lower, extremely lower than the prices at which they are trying to sell it in India. Okay, only then you can call it as dumping. But safeguard can be, they are not manipulating the price, but the rice prices itself have come down, let's say, because of excess supply in the global market. And they obviously want to sell it at the same rate in India. But that is a sensitive item. Excess import of such item is creating trouble for my domestic market. So I can come up with a safeguard duty in spite of there being no dumping. There's no dumping done, but effectively the prices have come down. For example, steel prices have come down in the recent past in the global market because of lack of demand. Why lack of demand? Is because of Trump. Got the point, right? So much of unrest, so businesses are not expanding. Businesses are not confident that they have to produce. Capital expansion is not done. They're not buying. They're not buying because they're worried. It's not about inventory, no? I can't accumulate inventory, keep on buying steel, but my demand is not there. So they stop buying, but supply is there for steel. And therefore the steel prices started going down in the international markets. This is how it is. Okay, but safeguards generally in WTO guidelines, safeguards are generally used for import sensitive items. Okay, and there are certain products in agriculture which are called as special products. So special products in agriculture are those products which we self-designate as special. For example, something that is very important for farmer, okay, because of food security. This is called a special product. So who designates them as special? Respective country. India self-designates rice as a special product. India self-designates wheat as a special product. So if there is increase in supply of such kind of items which are special, then immediately India comes up with special safeguard mechanisms called as SSM. Okay, this is what in the WTO discussion, but I think safeguard is clear. No dumping also, still I can come up with a safeguard duty. Okay. Composition. No, composition is not. See, GST, generally we file GST right now once every month. That means ideally filing GST 12 times a year, right? Okay. Earlier it used to be 3 times a month, almost like 37 times. This is not tax compliance. That means you have to open your laptop 37 times to file GST. That's not good. So later on they've reduced it to 12. Okay. But even 12 times is also difficult for smaller players. Okay. And therefore government came up with a scheme called as GST composition scheme. Okay. So what is the scheme is, initially it was only for manufacturing units. Now it is extended to service companies also. GST Council has extended it to services also. So this manufacturing company whose turnover is less than 1.5 crore can apply if they want for composition scheme. If you apply, what are the benefits? One benefit is you are going to file GST maximum 4 times a year. Every 3 months. You're not filing it 12. Okay. Second, the regular slabs are not applicable to you. These slabs are not applicable. These composition scheme, under composition scheme, companies pay a certain percentage of their turnover as tax. They don't pay 8%, 15% like that. So certain percentage of turnover, let's say 0.5% of turnover is paid as tax, a specific percentage of, and one more thing, you can be in composition scheme only if you're doing intra-state trade. Only intra-state means if I'm in Delhi and selling it to Maharashtra, it becomes interstate. Interstate means applicability of composition scheme will not be there. Automatically you have to take regular GST. Okay, and then you're not eligible for, under composition scheme, you're not eligible for ITC. ITC is what? Input tax credit. Currently, it is also there for services also. Services turnover 50 lakhs, less than 50 lakhs. Who decides that? GST Council. Okay, and then they're taxed at 6%. So this is what is composition scheme. What is this composition scheme? Earlier there was this question also. Composition scheme is related to, answer is GST. CAPF they've asked. And composition scheme is related to what? GST. That's all. They're not asked what it is, but they've asked it is related to what. So that time it was simple. So it is GST. So benefit of composition scheme, smaller players, input tax credit problem, input tax credit will come later. Till that time, my working capital is stuck. So for smaller player, that cash is also important. So that is what they talk about when they talk about no input tax credit. This is what is composition. Okay. Is that clear? No. Current imports of? No, safeguard duty will see. First of all, there is a logic behind coming up with safeguard duty. So one, I told you it should be import sensitive. Okay, and primarily it is used for these items like rice, wheat, which are special products as part of special safeguard mechanism. For everything you can't use it. Now, hmm, hmm. So your logic is, why is this import coming? This is the logic. You can't see. First of all, now situation is, why is the trade deal not being signed? What is at the center of that? What is the center of trade deal not being signed? What does Trump want? Agriculture. Even with, when we talk about India, Europe free trade agreements also, agriculture we have not exempted. We said tariffs will be there on agriculture. Welcome to that. But Trump wants soybean, Trump wants rice, Trump wants his milk to easily move into corn, to move into India. So this is the crux point. So you're talking about cotton. But these products also, he wants them to be equally placed with Indian products in India. Okay, so now if you go and levy taxes on everything, then you will not be able to complete the trade deal also. And moreover, WTO is just there. Okay, so WTO is not there. It is just there. It is there, but it is useless. Got the point? It is there, they're discussing, and nothing will come up because the judges are not there. In the appellate tribunal, in classes we discuss, appellate tribunal is there, no, judges are not there because judges are reappointed every 4 years. US is blocking the reappointment of judges, so judges are not there. So the judgment itself will not come now. Okay, so therefore, these are the issues. So right now you're taking decisions not based on WTO, you're taking decisions based on what to do so that we will move forward. But the point, right? Farmers are struggling, that everybody knows. Farmers are struggling, these products will create trouble. We all know that. That is the reason for agriculture. Because of agriculture only, the trade deal, primarily agriculture, auto components, labor intensive sectors like textiles. So Trump is targeting labor intensive sectors like textiles, auto components, and agriculture, and prawn. All are labor intensive. Okay, so that's. See, two things. Have you heard of anti-profiteering authority? Okay, so what does anti-profiteering authority do? Its whole logic is very simple. Of course, there are some lacunae problems also. Anti-profiteering authority is simple. For example, something is removed from 18% slab to 0, health insurance. The expectation is the insurance company should also pass it on to the final customer, okay, within a certain period of time. If it is not able to do that, you have to call the customer, pay back the interest also. Okay, this is one. You know this? No. See, there is something called as anti-profiteering clause in GST. Anti-profiteering clause means to prevent profiteering. What is the meaning of profiteering in GST? If the GST council has reduced the tax rate, the expectation is the supplier also has to reduce the tax rate for the consumer. If you are not doing that, then anti-profiteering authority can go against you. So if anti-profiteering authority identifies your transaction as like profiteering, then it is your responsibility to identify the customer and pay back that excess tax you have collected. For example, something is in 18% is in 0, but you collected 18% from the customer, but you're not paying it to the government because the customer is innocent. You have done that, but you're not paying it to the government. So this is called as profiteering in GST. So this anti-profiteering authority comes into picture, and it will ask you identify, pay it back. If you're not doing that, then put that in consumer welfare fund. There's a fund called consumer welfare. You put that money there, and that will be used for consumer welfare. This is the rule. Otherwise, they can go to the extent of cancellation of your GST license also. But of course, one problem here is, what about goods which have purchased? Companies have already purchased goods at different rates already. So government is silent on that. See, that means I have purchased some goods from in the market at 12%. Okay, now you have removed it, you have put it into 5%. Now the way I'm going to sell it in the market, so what about the goods which are purchased already at those rates? So what should the supplier do? That is a negative aspect in the GST 2.0. That means government is silent with respect. No, Competition Commission of India is for the whole competition. No, you have regulatory bodies like you have TRAI, Telecom Regulatory, like that. Okay, so Competition Commission of India is different. So it regulates competition on overall basis. No, this is specific National Anti-Profiteering Authority specific to GST. Okay. First of all, you can't collect as per regular GST. So when you're collecting also from the consumer, you can't collect as per. See, you're not paying 18% means you can't collect 18%. See, here the question is, what will happen initially? What will happen is the cement procure. Suppose a small builder is there whose turnover is less than, but this is mainly for manufacturing units. So automatically you're talking about builders or very educational institutions. 50 lakhs is the turnover. Automatically they'll fall in the regular GST. So this is primarily for the manufacturing units whose turnover is less than 1.5 crore. Okay, so suppose you're not in GST, what do you do? Suppose you're doing a transaction, you're not in GST. Now the question is, either in the circle it should be reverse charge, or it should be something like you're not going to collect it from the consumer also, because you're not paying it to the government. Same logic applies here also. You're not going to collect and pay it to the government. Okay. Enough of doubts now. Okay, we'll move forward. So now see here, this is the next topic. This is about money market and capital markets and these kind of topics. Okay, so there are a lot of questions in concepts that they have asked earlier. Okay, so first thing is, here you can see there are some instruments very clearly defined. Okay, so two things here: money market, capital market. Money market is regulated by RBI. See, money market can be regulated money markets, that is organized money markets or unorganized money markets. Organized money markets are regulated by RBI. Unorganized money markets are all money market instruments are also there, like Hundi. Already there was a history question asked earlier. Okay, so Hundi is unorganized money market instrument, which is similar to bill of exchange or commercial bill. Okay, only organized money market instruments are accepted by banks and institutions like RBI. Unorganized money market instruments are not regulated by RBI. They are not accepted by the banks. Then who will accept those unorganized money market instruments? Instead of banks, maybe the money lender. There's a money lender or the local shaukar, he will accept those bills. Based on trust between two parties, he will accept. But banks will not discount those bills. Banks will only discount bills which are in the organized market. Who are the participants in organized money market? You have RBI, you have banks, we have NBFCs, non-banking financial companies. Okay, we have government. Okay, and we also have private players. So what are the different instruments that are there when we talk about money market? So two important observations. Money market, always we talk about short-term instruments. Capital market, we talk about long-term instruments. Money market instruments primarily are discounted securities. Discounted securities whose maturity period is less than 1 year. Whose maturity period is less than 1 year. Here in the capital market, you have both debt instruments as well as equity instruments. In the debt instruments, you have dated securities. Remember yesterday we used this word, dated securities whose maturity period is greater than 1 year, like the GSEC, state development loans. These are all in the capital market. Are you able to get this? And then you also have the equity instruments. Capital markets are regulated by SEBI. Organized money market is regulated by RBI. I hope it is clear till there. There's no confusion. Okay. So one more important observation here. Money market instruments, you can see regulator RBI, risk, duration less than 1 year. What are the common money market instruments? See, you'll remember first government related money market instruments, which government issues. One is T-bills or treasury bills. I think everybody knows treasury bills. Then you have cash management bills. Cash and management bills. Okay. Then you have ways and means advances. Using ways and means advances, government borrows from RBI. Here government is borrowing from whom? RBI. Using GSECs, government is borrowing from the market. Using treasury bill, government is borrowing from the market. Can you buy T-bills directly? Yes, you can buy T-bills directly. Can you buy GSECs directly? Yes. Can foreign portfolio investors buy GSECs in India? Yes. These are all questions already. Foreign portfolio investors can also buy GSECs. Okay. So I think till there it is clear. Okay. Then government related money market instruments I mentioned, treasury bill, cash management bill, and ways and means advances. Private, you have commercial paper. Okay. And you have banks, you have certificate of deposits. Yesterday we have discussed certificate of deposits. Okay. And you also have certain instruments which are called as commercial bills. Commercial bill or bill of exchange. Okay, so organized money market, very simple. We have the participants, RBI is there, banks are there, NBFC is there, government is there. Okay, and you have a call money market also. Call money market. Okay, these are all. Okay, so here when we talk about government related instruments, one is treasury bills. Treasury bills, you have 91 day, 182 day, and 364. And if you want to borrow for less than 91 day, you have cash management bills. Government wants to borrow for less than 91 day, you have cash management bill. Okay. Then when we talk about banks, you have certificate of deposits. Yesterday we have discussed the difference between FD and certificate. Tokenization of certificate of deposit. That is what we have discussed. That is also a money market instrument. Minimum 7 days, maximum less than 1 year. The maturity periods here is less than 1 year. What is call money market? Interbank borrowing for a period of 1 day. If it is 1 to 14 days, it is notice money. Okay. So 1 day, it is call money. 1 to 14 days, it is notice money. More than 14 days up to 1 year, you call it as term money. So here 1 day interbank borrowing, call money, 14 days, 1 to 14 days, it is notice money. All these are money market instruments. Okay. Then we have, when we talk about the private, one is you have commercial paper. Commercial paper. So the way government is borrowing, the private players also borrow. And these are all accepted by banks. These are all in the organized money market. These are basically called as zero coupon bonds or non-coupon. That means no coupon announced, no interest. Treasury bills, do they offer regular interest? No. Cash management bills, do they offer regular interest? No. Remember this, they don't offer regular interest. Okay, so then what do they do? These are discounted securities. You are issuing it at a discounted value on the discounted price on the face value. Discounted price on the face value. 100 rupees, you are issued it at 80. This is the face value. You have issued at a discounted price, but after 90 days, you are giving them 100. So your return is something like Is that okay? Understood? Clear? Okay, so this is 25%. Okay, so you don't get so much of return, so hardly 3-4% you get, but just an example, these are all discounted securities. So these are all money market instruments. And you also have something like the ways and means advances. Ways and means advances. Yesterday we were talking about 90 days at repo rate. If it is above 90 days overdraft facility, the rate would be 2% higher than the repo. These are all short-term debt instruments issued at discounted rates and purchased at original face value. Is that okay? Yes. Okay. Now in the capital market, see, can money market have, see, all the securities market has primary market as well as secondary market. So when we say primary market, you are directly buying it from the issuing entity. When you're directly buying it from the issuing entity, you call it as primary market. When you're buying it from some other entity in the market, you're calling it as secondary market. So there's a difference between primary and secondary market. I hope it is clear. So for bonds also there is primary and secondary market. So the secondary market liquidity is enhanced in the money market through an institution called as DFHI. There's an institution called Discount Finance House of India. To be very specific, it is called as SBI DFHI. Earlier it was under the control of RBI. Now it is under the control of SBI. SBI DFHI. It provides the secondary market or liquidity for money market instruments. See, money market instruments can also be sold in the market. Are you able to get this? Okay, so that liquidity is ensured through such institutions like Discount Finance House of India. Is that okay? Now coming to capital market. So capital market is regulated by SEBI. Okay, so what are the different instruments here? So one is basically the debt instruments, which are the dated securities. Dated security means long term, whose maturity period is more than 1 year. Okay, so it can be GSECs, state development loans, etc. Even debentures and bonds are also part of capital market. There was a prelims question, simple question. Okay, so which of the following is part of capital market? Debentures and bonds. So debentures are unsecured loans, or these are bonds issued by corporates generally. These are unsecured loans. These are issued by corporates. Okay, so these are also in the capital market, right? And then you have the equity instruments. Equity instruments, in the equity instruments you have shares. Okay, you have derivatives. We have mutual funds. Okay, we have ETFs. All this will also fall in the capital market. Everybody is able to get this. I think there's no confusion there. Mutual fund, ETF, shares, derivatives, everything is here. When we talk about shares or equity instruments, there is somebody called as a preferential shareholder and equity shareholder. So preferential shareholder, equity share, but ultimately there are shareholders only. So shareholders are here. I hope it is clear. So capital market has debt instruments also as well as equity instruments also. That is what is understanding there. And here you see your shares are there, bonds, debentures are there. Okay, so and here you can see primary market, secondary market classification here. So what are the instruments in the primary market? Okay, so one is, you know about public offer, FPO. Okay, there it can be private placement. This is public offer, IPO. If a company is issuing shares for the first time through which it is getting listed, you call it as IPO. After getting listed again it is issuing, then we call it as follow-on public offer. Public, everybody is investing. Private placement, only a selected few are participating, not all. Okay, and then you have okay, all these are in the primary market. Rights issue means, as a matter of right, the shares are going to the existing shareholder. That is rights issue. Preferential shareholders always have a preference over the equity shareholder. For example, whenever a company is on the verge of bankruptcy, who will be settled first? First is bond holders, then followed by shareholders. This is what UPSC asked. Okay, here also in this bond, if I want to talk about debt also, one is you have senior debt. Yesterday we have used a word called subordinate debt. Okay, so if I have to give rankings there, they will be settled first, then they will be settled. In shareholders, one is you have a preferential shareholder who is given a preference over the equity shareholder in terms of settlement. First he will be settled and then equity shareholder would be settled. Equity shareholder is seen as real owner of the company. Real owner is equity shareholder, not the preferential shareholder. Real owner is equity shareholder. Is that okay? Equity, see, UPSC question was first who settled. So preferential shareholders have a preference and they have an assured dividend guarantee. The equity shareholders, there's no dividend guarantee. There's nothing like certain percentage of dividend will come to you. That is not there for the equity shareholders. That is only there for the preferential shareholders. Then why do you have preference? Why companies go with preferential shareholder? Because without diluting ownership also completely, you're able to get some capital. Are able to get this? The logic. It's not like just like that they will go. Okay. So I hope it is clear. Understood, everybody, right? In the secondary market, you have the stock exchanges, you have the BSE, NSE, where you can go and buy shares, you can buy commodities and many other things, right? Right? Okay. See here, what is this? We'll try to understand. Very simple only, if at all they ask. Okay, so one is SEBI has relaxed key regulations and introduced this entity called Swagat FI. So here if you see, single window automatic and generalized access for trusted foreign investors. Okay, what is it? This single window automatic and generalized access for trusted foreign investors. Okay, so that means procedures would be more simplified for the foreign investor to easily invest in the market using this entity. So here who can participate? One, foreign portfolio investors, and you also have foreign venture capitalist investors. Generally, what is the difference? Portfolio investors, generally, they can also invest in unlisted companies also. They can go for listed also. Okay, portfolio investors can, if they want, they can push their money anywhere. But here, one important understanding you should have. If you know the new definition of FDI and FPI, which is Arvind Mayaram Committee's recommendation. So it is based on the percentage of holding. So if you are holding 10% of paid up capital of a company, any investment into a listed company, any investment into a listed company which is greater than equal to 10% would be treated as foreign direct investment. 10% of what? 10% of paid up capital. What is paid up? It's not authorized capital. It is paid up capital. Authorized means company can raise 5,000 crore, but company up to 5,000 crore it can raise. But paid up capital is shareholders capital. So shareholders capital is 100 crore. If this company crosses 10 crore, touches 10 crore, okay, so this FPI investment henceforth will be treated as FDI. I'll talk about that in the next topic. There is this discussion there. Okay, so I think it is clear. So it is about control over the asset. If you have more control over the asset, you're treating it as FDI. Control over the asset is the new definition. Control over the asset above 10. 10 and above, control over the asset is more FDI. Less control, less than 10, you're calling it as portfolio investments. This is for listed company. This is what Arvind Mayaram says. Unlisted company, it is little different. Unlisted company, any investment will be treated as FDI generally. Okay, I hope it is clear. So through this mechanism, there can be money moving. Okay, so it is simplifying procedures for FPIs and foreign venture capitalist investors. So when we talk about FPIs, and FPIs invest in listed securities like bonds, derivatives on public markets. Venture capital investors generally look for venture capital funds. So venture capitalist investors, foreign venture capitalist investors, they have invested in Byju. They have invested in PhysicsWallah. They have invested in many other companies. They have also invested in Lenskart. Lenskart was asking for 10 times valuation. 10 times. Okay, so hopeless. Okay, so we'll talk about Lenskart sometime later. But initially there were investors for Lenskart also. Who are these investors? Venture cap. So you have venture capitalist investors, angel investors. Venture capitalist investors are generally companies. These are companies which invest into risky startups. Angel investors are generally individuals who also invest into risky startups. Angel investors generally give seed capital. Seed capital, initial capital for doing business. That is what is angel investor and venture. So you're relaxing norms not just for foreign portfolio investors, but also for venture capitalist investors as well. So venture capitalist investors invest into risky startups generally. These are companies only which raise funds and push their money into risky startups. I hope it is clear. Okay, so there is a difference between foreign institutional investment and domestic institutional investment. Both are institutions only. That means the money is coming through the route of institution. For example, a mutual fund institution is there. It collects money from all of us and it invests. It's more like a DII. DII is what? Domestic institutional investment. Similarly, if the foreign entity which is there, it is collecting money from the foreign players and that company is investing in India, then you're calling it as foreign institutional investment. As simple as that. Is that okay there? Right. Participatory notes are provided by FI. Yes, these are offshore derivative instruments. I'll come to the derivative when it comes. Okay, P notes is asking. P notes are offshore derivative instruments issued by FII. This was a previous question already asked long back. Yes. FI. See, every Tom, Dick and Harry cannot be an FI investor. And that is the reason you have P notes. If you don't want to give your complete details, these FI investors come through the route of participatory note. Okay, so participatory note, you need not give all the details to the SEBI. No, see here, participatory note. See, participatory note is something like, suppose there is a company, a foreign company, Morgan Stanley, some company, a foreign institution which has already taken license from SEBI. Instead of issuing shares, what this company does, it buys shares and keeps it in its locker. And based on the valuation of this share, let's say a paper is issued. This is a paper. Now this paper is nothing but a derivative instrument. Derivative means something that does not have value of its own. Its value is coming from underlying shares. Okay. Now this is a P note or a participatory note. Now instead of these FI investors, they do not directly get themselves registered with and complete details are not submitted to SEBI. So instead what they do, they buy this derivative instrument. Okay. So instead of buying direct shares in the market, they're buying derivative instrument called P note. Now these P notes, if you want to buy these participatory notes, which is a derivative instrument, your complete details need not be given to the SEBI. And moreover, these P notes can change hands. You can sell them in the market. So somebody else can buy this P note. Whoever is buying, there is a lot of anonymity. Anonymity is you don't have the complete details of those. So who issues these P notes? It is this FII institution. Morgan Stanley is an institution which has already taken a license from SEBI to operate. That is what is participatory note. It's an offshore derivative instrument. Derivative which is held by somebody who's outside India. That is why we call it as offshore derivative. Okay. Is that clear? So here are two things. Regulations introduce Swagat FI framework to improve what? Investment friendly environment and reduce regulatory complexity. Not only for portfolio investors, but also for venture capitalists. That is what you'll remember. Okay. Then talking about SEBI, I think you should already be knowing about SEBI. SEBI is a statutory body. Okay. And SEBI regulates the capital markets. SEBI also regulates forward markets today. Okay. Forward markets, earlier forward markets were regulated by Forward Markets Commission. Now forward markets are regulated by SEBI. Okay. So enforcement and investigation powers, including powers similar to those of a civil court under the Code of Civil Procedure 19. Okay, so now this framework, we have talked about this framework, and also another important observation here. Okay, reclassification. So what they have done, they have come up with reclassification of REIT as equity. Now in simple words, I will explain. REIT is Real Estate Investment Trust. Okay, what is the meaning of reclassification as equity? What is the benefit? I will tell you. That's more than sufficient. Okay, so reclassify. See, first of all, what is the purpose of REIT? See, if you want to invest in real estate, it is very difficult, especially commercial real estate. Suppose you want to buy something in Noida, or you want to buy something in Delhi, it's very expensive. Suppose you have only 50,000 rupees or 1 lakh rupees, but still you want to invest in real estate. You have one option. That is basically, you can invest through this trust. That is called as Real Estate Investment Trust, as simple as that. What this trust will do, it will collect money, pool money from us. It will invest into a real estate property. Based on the amount you have given, some units will be allotted to you. Like how the mutual fund units are allotted to you. In the similar manner, units will be allotted to you. That means, indirectly, you are holding some commercial real estate. Indirectly, you're holding some commercial real estate without paying, without having so much of capital. So basic difference between real estate and equity, with less capital also I can enter equity market, but with more capital only I can enter real estate market. This is one. Second is liquidity. Whenever I want, I can sell the equity shares and liquidate and get my money. Real estate, whenever I want, I can't sell and get my money. It will take some time. So there are positives. Real estate is more stable in comparison to equity. Equity is less stable. Example now, Trump, every decision he takes, the market goes up and down. Right? So there are benefits of each entity. But now the infrastructure is a big challenge, and funding infrastructure is a big challenge. So to fund infrastructure, lot of things were done. For example, government has come up with National Infrastructure Pipeline, PM Gati Shakti, monetization pipeline, national logistics policy. I'll talk about that in the infrastructure discussion. All this was done. Similarly, how do I pool funds for investing into infrastructure? They came up with InvITs, Infrastructure Investment Trust. Already there was a previous question. Go back and check the question once. There was a previous question on InvITs, because in the budget they made some changes on InvIT. So what does InvITs do? Here the trust collects money and invests money into some infrastructure. So the whole logic is you're trying to push money into, you're collecting money for an existing project. For example, there's a road already there, which is already functional. Toll collections are coming. Then you are investing into that road. And National Highway Authority of India, let's say, it is pooling this money, it is collecting this money. Now this money is invested into that road. Some units are allotted to you. As and when revenue is getting generated out of that road, because people are using it, you are paid regular income, and there is tax also on that income that is paid to you. This was the question asked. So what is government trying to do? Government is trying to use its existing assets, generate revenue out of these existing assets or the brownfield projects, and use it for new projects or greenfield projects. So funding infrastructure is a challenge. So one way of doing it is InvITs is one. Similarly, funding real estate, they've come up with new mechanism, that REIT, Real Estate Investment Trust. Now what is the change which SEBI has brought in? Change is this REIT is seen as a hybrid instrument, not as equity instrument. What is the meaning of hybrid instrument? Hybrid instruments are those instruments where you can't spend more than 10 to 15%. That means, let's say mutual fund institutions are there. Mutual fund institutions, when they're collecting money, they can't push more than 10 to 15% of that money into REIT, because REIT is seen as a hybrid instrument. There are different instruments. There's something like equity instrument, there is debt instrument, there is hybrid instrument. I can't help. This is the news. Okay, so what is the news? News is, which is written here, is, if you read it, reclassification of REITs as equity. That means earlier it was not treated as equity. That means earlier it was treated as what? Hybrid instruments. What is the negative of treating it as hybrid instrument? Mutual fund inflows will be less into REIT. Why? Because mutual fund institutions cannot push beyond a certain upper benchmark. Suppose your fund is 100 crore. You can't push more than 10 crores or 15 crores into hybrid instruments. Such restrictions are not there on equity instruments. So now SEBI has put REITs as part of equity instruments. What will it do? More funds will move into REIT. Positive aspect. Negative. What is the negative aspect? Volatility. Buy, sell, like the shares you buy and sell. So it will become more volatile. REITs are regulated by SEBI. You buy and sell and buy and sell. InvITs are classified as debt instruments as per SARFAESI. Okay. InvITs are classified as debt instruments as under SARFAESI. FPI, we don't talk, with respect to FPI, we don't talk about long term, we only talk about short term. You said FPI means we are talking about short term only. As simple as that. We don't talk about long term. Of course, FPI outflows, that will come up in the next chapter. When we talk about FDI, FPI, we'll talk about that in the next chapter. Okay. More outflows means rupee value will depreciate, as we are seeing 92. That is anyhow there. Okay. So all these problems will be there anyhow. Okay. So more foreign investment is moving out of India means our rupee consistently depreciates. This is the problem. It is with respect to net foreign direct investments also. Investments were coming in, but outflows are also there. That comes up in the next chapter. We'll see that. Okay, so there were also some norms which were liberalized even for IPOs. Okay, so issuers holding up to 25%. So that is basically, it is relaxing norms with respect to IPO. It has relaxed norms with respect to REITs. Okay, and then Swagat FI framework has been brought in to facilitate transparency and easy methods for FPIs and foreign venture capitalist investors to invest. This is what is sufficient. These are the result of SEBI meeting. See, there are a lot of concepts, but the question is, we have to focus more on current. So that is the reason it is better that you go back and revise concepts and come. Got my point, right? So otherwise, what is happening? Of course, nothing wrong from your side, but the speed is going to come down because everything is a concept. For example, every word is a concept in certain chapters, and you should at least superficially know a few things. Superficially, if not complete. At least you know. Okay, you know what is a mutual fund at least. That's the only thing. It's not that you know the depth of mutual fund. UPSC also doesn't ask you all that. UPSC is also very kind of. So UPSC may ask, how does an REIT function? UPSC may not. I don't think UPSC. Of course, it is here. Therefore, I've explained. So that is what you should understand. You're treating REITs. So if at all UPSC is giving REITs are henceforth treated as equity, means it's a very difficult question. And not a hybrid instrument. I don't think so. UPSC. It's not a SEBI exam. But it's there. Therefore, explained it. So not dig deep there. So we understood, right? So it's very important that we hit maximum number of questions that are coming in exam in prelims because of our discussion. That should be the primary objective. Secondary objective would be expansion of knowledge. What? Got the point? Like, yes, let's expand. We can do trading also. Okay, so not like that, right? Yes. So now come back now. See here. Who regulates mutual funds? SEBI. Now one more question. There are certain funds which are called as alternate investment funds, right? Who regulates alternate investment funds? SEBI. Here, if you observe, this is important. AIFs are regulated by SEBI as per SEBI Alternate Investment Fund Regulations 2012. Is that okay? Everybody's understood that. Now, what are these alternate investment funds? Can everybody invest in these funds? No. Who will invest? Sophisticated individuals and institutions. Suppose I have 1,000 crores in my pocket. If I feel let this 50 crores go into AIF. If I don't get back 50 also, it's okay. It's not for those who have 1 crore in their pocket and they feel rich and they'll put 50 lakhs from there into AIFs. It's not for everybody. It's not like the mutual fund. These are for sophisticated or high net worth individuals and institutional investors. This is one. Okay. So I hope it is clear. Where do these AIFs push their money? They can push the money into real estate. They can push the money into startups, venture capitalists. They can push the money into derivatives. They can, if they want, push the money into Latin America. They can push it into Colombia. You should not ask. You should only ask, what is my return alpha? But that's all. You should not ask, where are you putting my funds? You will not get that return if you are doing only in India. See how Indian market is. Nifty gave 0 last year. Are you able to get this? So that means these funds managers basically they take huge amount of risk. They put the money into different areas. They don't stick to a single area. Okay, that is something which you will understand. There are different categories. Now I'll explain this. Before I explain this, there are different categories of alternate investment funds. For example, here if you see, one is the category 1 talks about venture capitalist funds or angel funds, or these are all startups. Alternate investment funds, where your category 1 AIFs means money is going primarily where startups, and then you have category 2 AIFs which are private equity funds, real estate funds, debt funds. Okay, and then you have category 3 AIFs which may use leverage, including through investment into listed or unlisted derivatives. Derivatives is also risky. So that means whether it is category 1, category 2 or category 3, the money is going into risky entities. So unlisted companies also they will invest. They'll invest into real estate also. They'll invest into derivative markets also, or they'll push their money into startup ventures also. This is what is understanding. Who regulates AIFs? SEBI. Now one important observation here. Here there is something like SWAMI, special window for affordable and middle income housing. Okay. So what is this? It's a government-backed fund from its tightened rules of AIF. So RBI has exempted this fund from its tightened rules of AIF. RBI prescribes the regulatory guidelines in respect of investment by the regulated entities into AIF. So when I say regulated entities putting their money into AIF, there is risk. For example, banks are regulated entities. NBFCs are regulated entities. Now you also want to put money into AIFs, then there are certain guidelines and regulations. Why? Because there is a high amount of risk involved. That is why here you see RBI. Otherwise RBI is not going to regulate AIF. Who is regulating alternate investment fund? It is SEBI. SEBI regulates alternate investment funds and not RBI. So what is this fund? Special window for affordable and middle income housing fund. So when we look at this, see, this is basically related to real estate fund. For example, a builder has come up with construction activity and you have pre-booked and you have given money already. You have given 50 lakhs to the builder and you are expecting the builder will complete the project. But many builders in Noida, you look around Noida like this, you find buildings halfway done and stalled. Real estate very dangerous in Noida. Okay, why? Because there may be some complaint, he's not able to finish it, and maybe he has gone to some criminal something or whatever it is, he's not available. Now what has happened to individuals? Their money is blocked. There are many court cases filed by these house owners who are asking for their property. And to facilitate something for them, where government tries to enhance, take some precautionary measures, and so that you complete the house and give it to these middle income households. There is a fund that is created that is basically special window for affordable and middle income housing fund. It's a government backed fund. Is that okay? Now this fund money is there, that money which you are pooling. So that, why are you pooling that money? So that you will try to do this activity so that that house owner will be able to get his house. So such entities also should not be pushing money as they like into AIFs. Some regulation is there for them. And similarly, regulated entities also, some regulation is there. Regulated entities can be like banks in terms of pushing the money into alternate investment funds. Is that okay? Who are anchor investors? So anchor investors are those who are called before IPO to create demand for IPO. See now, IPO is consistently new, so therefore there can be a question on IPO in the exam. Remember this. Okay, anything related to IPO can be important for the exam because consistently there is a discussion. They'll not ask any technical questions, but there can be a question on IPO, initial public offering. So anchor investor is somebody who's called before the IPO is issued. He's an institution who's called. Why is he called? To create demand for that IPO. Suppose you're calling some institution or a bank or an LIC company to invest before the IPO is issued. This will bring in credibility before you issue IPO. Are you able to get this? They are called as anchor investors. Can promoters sell their shares in IPO? Yes. Most of the IPOs, if you observe, promoters are selling their shares and getting away. These small things you should know. You need not know about authorized capital or what is paid up capital, then what is subscribed capital. All that technical words they will not ask. But at least you should know owners can sell in an IPO. IPO is part of primary market. Who regulates IPOs? Obviously SEBI. Are you able to get this? Okay. Who's an anchor investor? You should know. Who's an anchor investor? Somebody who's, because with respect to Hyundai IPO, many IPOs is word called anchor investor. Can promoters sell their share in an IPO? Yes, promoters can sell and get out also. That is also there. IPO is for two things. One, you raise funds so that you do business. Two is you want to sell and you know your business about your business, that it's useless. So you want to sell and get out as early as possible because if you're going to stay, you know you'll be in trouble. So many promoters are moving out during IPO, means we should be very cautious about the business. This is what it is. That means through IPO, they want to make money and get out. I hope it is clear. Okay. Then insider trading. Insider trading is illegal in India. What is insider trading? Something that information is not public, but there are some insiders who have the information based on which they are buying the instruments. Is it legal? No, it is illegal in India. This is called as insider trading. Will it happen? Yes, it happens regularly. Got the point? So insider trading is something like non-public information. Okay. On similar lines, there is something like front running. Here you can see this. Front running. I hope you're able to follow. Right? So what is this front running? It is an illegal practice of purchasing a security based on advanced non-public information. Suppose, let's say, there are a lot of block deals. More than 1 crore, 2 crore, 5 crore, 10 crore, they're buying a particular share. That means some insider information is there. Or something is there. And your broker is there. Let's say Zerodha or somebody. Kotak Security. Now let's say the broker decides to buy first. Because he has seen the demand already. This is also front running. Are you able to get this? You are not able to buy, but the broker is able to buy. Because broker is able to see. Broker has seen, oh, Rakesh Jhunjhunwala is buying so much. Okay, that means there is something in it. So let me buy first. Let's not permit him to buy. Are you able to get this? Okay, so here if you see, it is an illegal practice of purchasing a security based on advanced non-public information regarding an expected large transaction that will affect the price of a security. Because when somebody is putting 100 crore, 200 crore, the share price is going to go up. You know this is coming, so you buy. Once he buys, goes up, you sell. Very simple. So that is the reason bigger institutions can make money easily. Simple logic. Because there are many things which you don't know. I hope it is clear. It is considered as a form of market manipulation as it leads to security price movements being manipulated based on non-public. What do you mean of non-public? Everybody does not have the access to that information. Is that okay? Understood, right? So example, broker executes own order based on client's large stock order. I've given the same example. Okay, based on client's large stock order. It can undermine market integrity. Some students keep saying, sir, whenever I buy, it will go down. Okay, so because whenever you're buying, on the other side, institution is selling. And that is the reason whenever you're buying, you're losing. Because you have to buy when the institution is buying. You have to sell when the institution is selling. You're doing the reverse. You are buying when the institution will give you news also. News also, 2 days back in the newspaper, you will find news. You think, I am reading current affairs. And you feel that, yes, you have decoded something. And you start buying. And once you start buying, it keeps on falling. You don't understand. That news was there 6 months prior in the institution's pocket. You have got it after 6 months by reading Hindu. You feel like you know it. This is the problem. No, this news is wantedly given to you so that you will buy. Because when you buy, only he can sell at that high price. Without logic, you want to sell at that high price. Who will sell? Irrational retail customer will buy. Okay, so who's a retail customer? No, not irrational. There's a 2 lakh. Okay, so basically when we're talking about subscribing to shares, less than 2 lakhs. Okay, so that is a definition. I think it is clear, understood. So front running. So what are the words? Front running. Okay, derivative. I'll come to this. And these are, I think AIF is clear, right? Last time there is a question. Which of the following is a financial instrument? UPSC is very kind. And they gave swaps. They gave ETF, I think. They gave vehicles. And they gave something else, I don't remember. Vehicle is not a financial instrument. Other ETF is a financial instrument. Derivative is a financial instrument. Swaps are also derivatives. I don't know. Venture capital is there? No. No venture capital there. As far as I remember. Is there? Okay, fine. If 2 people are saying, then it should be there. I have to doubt my memory then. Okay, no problem. So here what I want to tell you is, if you know that it's a financial instrument, that is sufficient in the exam. Okay, so derivative, financial instrument, right? Mutual funds, financial instruments. Bonds, financial instruments. Swaps are also financial instruments. In fact, swaps are also derivatives. So what are the different types of derivative? First of all, derivative is something that does not have its own value. Its value is coming from underlying asset. As simple as that. For example, gold futures. That means the paper future, gold future is a paper. That paper's value is being derived from underlying asset. That is gold. Simple. Silver future, gold future, Reliance Industry futures. All these are derivatives. Their value is derived from underlying asset. Underlying asset can be shares, underlying asset can be gold, underlying asset can be silver, oil, natural gas, crypto. All can be underlying assets. I hope it is clear. Okay. Now, derivative trading is the most dangerous. That is why SEBI has come up with a lot of regulations on derivatives. What are the different types of derivative? Forwards, futures, options, and swaps. These are what are. Who regulates derivatives? SEBI. Okay. What is the benefit of derivative market? What is the benefit of derivative? Why there is a derivative market? That's not the, you're doing that. That's not the logic. Logic is one, hedging, HEDGING. Suppose there's a question, which is the benefit. It's not technical. No? Hedging is what? Avoiding risk. So one benefit of derivative is your hedging. I hope you are able to get this. I hope it is clear. Suppose you have Reliance in your pocket. Reliance is falling. Okay, you are buying Reliance put option so that you're trying to hedge the risk. This is hedging. Another one is speculation. Speculation, short-term buying and selling. Speculation and hedging are the main benefits of derivative instruments. You can buy more, leverage, all that. No, that is not benefit. That is okay. That is permitted by SEBI. Is that okay? Fine. Here you can see futures and options are the most commonly traded equity derivative products. I hope it is clear. Facts. Okay. Now here, Gift City. See that? Okay. So when you, where is this Gift City? First thing you should know, Gift City is in Gandhinagar, Gujarat. Okay. Now what is this Gift City? Gujarat International Financial Tech City, FinTech City. Right? It has been established as India's first and only international financial services center. International Financial Services Center. Is that okay? Yes. It is a jurisdiction that provides onshore and offshore financial services. That means there are financial services which are provided to whom? Financial services provided to whom? Non-residents and resident institutions. Is that okay? Non-resident and resident institutions in foreign currency. That is very important. Here the transactions are in foreign currency. These can be statements in exam. One more important observation. This is established, Gift City is established as a special economic zone. Okay. Designated as non-resident zone under FEMA guidelines. Everybody knows SEZs, special economic zones. The purpose of SEZs. One of the purpose of SEZ is to increase forex also. Everybody get this? One of the purpose of SEZ is increase forex. Why? Because you have to focus on exports in an SEZ. So when you're focusing on exports, obviously you're going to increase forex. Same logic here. Here the transactions are in foreign currency. Is that okay? Yes. And regulatory body here, who regulates this? International Financial Services Center Authority, IFSCA is the regulatory body, underline that. So regulatory body here, IFSCA regulates financial products, financial services and financial institutions in IFSC. International Financial Services Center, whatever institutions are operating, they are regulated by IFSCA. I hope it is clear, right? Now that is about Gift City. Now what did they do? Why is it in news? See, Ministry of Finance launched foreign currency settlement system at Gift City. What they have done, they have launched a foreign currency settlement system at Gift International Financial Services Center. What is the benefit here? Easy settlement of foreign currency transactions. Otherwise, again, if it is done by a regular bank, it takes a certain period of time for settlement. So here, basically, it is like an in-house settlement of foreign currencies that is facilitated then and there through this FCSS. You need not wait for 1 day, 2 days. Immediate settlement is done because of this entity called FCSS there. Okay. So what is the objective? It enables foreign currency transactions between IFSC banking units to be settled locally instead of routing through the traditional corresponding banking route. Instead of routing it through the traditional corresponding banking route, it will be done then and there at that particular facility itself. Okay. So that will reduce the time, transaction costs, delays, etc. All that would be handled effectively. The system will initially settle transactions undertaken in US dollar. Pilot version, you're doing it with dollar. Now later on, again, you will do it with other currencies. Euro, you want to add, slowly you want to do it. Now the transactions will be immediately settled in dollars. Localized settlement. The function is localized settlement. Okay. So who operates this? Here you have Clearing Corporation of India Limited. Clearing Corporation of India Limited. Okay. Okay. These are facts. One is, what is Gift City? Okay. What is the purpose of existence of IFSC? Okay. Then which one is the regulatory body? IFSCA. Okay. And then why is it in news? It is in news because of International Financial Services Center Authority. What is the function? Localized settlement of foreign transactions. Currently it is doing it with dollars rather than following the regular channel. Yes, automatically. Ease of transactions becomes easy, then more investment comes. Yes. Movement will be more. This is all logic. Okay. So clear till there? Yes. See, these are factual, but don't think these are not important. Don't think they're not important. There can be questions, there can be factual questions. They can ask which one is the regulatory body, or they can ask it was established as an SEZ in 2015. That can be a factual statement. You get confused. You think SEZ, what is this? This is SEZ is for exports, for manufacturing units, for IT companies. This is the doubt that will come up in exam. Are you able to get this? Okay. So Till there is, I think it is clear. Is that okay? Now, instead of that chart, I will explain it better. Okay, so here, first of all, why there is a lot of discussion on every time there are, see, previous questions I will tell you. For example, previous questions were on, if you go back and see, there were questions on convertible bonds. There were questions on inflation index bonds. 2016, I'm talking about. Okay, there were questions on zero coupon bonds. This was 2020. T-bills, zero coupon, all this. These were already asked. Okay, there was question on inflation affects bond holders, inflation affects debtors. This is a basic question in 2012. So that is about inflation impact on bond holders. This is very basic in the beginning. This was in 2012. And then there were questions on convertible bonds, non-convertible bonds, etc. There were questions. Okay, so, and then there were questions on whether taxes are levied when government is issuing, when RBI is issuing inflation index bonds, etc. These were the questions already asked, right? Now, also there were questions on already asked. This is also already asked. This is all already covered in previous year questions. So masala bonds are rupee denominated bonds issued in other countries. Rupee denominated bonds issued in other countries. That is what is masala bond. So go back and check. There are some bonds like Maharaja bonds. Okay. Now in our magazine you have transition bonds. Transition, no? You have transition bonds, and I think there is additional tier 1 bonds or perpetual bonds. These are the things that are given in the magazine. Is that okay? Then first of all, two things. You see the concept there. Bond price is inversely related to bond yield. Okay. There was also a question on US Treasury bonds 2024. US Treasury bond. This was asked in 2024. So now one thing you should understand that everybody, I think you should be knowing this relationship between bond price and bond yield. So whenever you are talking about bond, one is the face value of the bond. Then whenever bond is issued, they also mention the coupon. These are coupon bonds. Only a coupon bond, coupon is mentioned. For treasury bill, these bonds, there is no coupon announced. Therefore, you call it as zero coupon or non-coupon. Here, coupon is announced. So what is the return on this bond in this case? So this is annual yield of the bond. There are in bonds also, there are something like yields to maturity. This is not we calculate. This is not what we calculate here. What are we calculating is annual bond yields. Yield to maturity means till the bond matures. What is the return you are generating? Here, this is different. This we don't discuss here. This takes time value of money also. Money is not same, no? Today's 100 rupees is not same after 10 years. When I'm getting the return, 100 rupees. So we're not doing this. What we're doing is annual yield. So here, annual yield on the bond, in this case, we are saying it is the coupon rate divided by, in this case, it is face value. Is that okay, everybody? Okay, so then suppose you sold the bond in the market for 90 rupees. This is called as bond price now. No more face value discussion. Why? Because the bond, you have sold it in the market. In the market, you sold the bond at a certain price. This is called as bond price. This is called as face value. So whenever the bond matures, what you get is the face value of the bond after the maturity period. But this price which you see here, 90 rupees, this 90 rupees is not the face value. This is the bond price. Your bond did not have demand in the market. Due to multiple reasons, other bonds which are giving better returns. So therefore, when you sold this bond after 1 year, you were only getting 90. But the coupon on this bond, I purchased it from you. Coupon will never change. Coupon remains the same. Coupon is 10 rupees only. For this fellow, for me, the return now becomes, so now for me, the return is 10 out of 90. 10 out of 90, that is basically the coupon rate divided by, not face value, coupon rate divided by current bond price. Here it is coupon rate divided. See, how will you check my return? How much did I invest? How much did I get? This is what I invested here, and I got 10 rupees. And that is the reason return is here. How much did I invest? 90. How much did I get? 10. So my return is 10 out of 90, or 11.1% is the yield in this case. Are you able to get this? So here one observation, when the bond price has reduced, here price has come down. Bond yield has increased from 10 to 11.1%. From there, we have written this equation. Bond prices are inversely related to bond yield. As simple as that. Okay. What is in news? Different countries, including India, are dumping US Treasury bonds. And they're dumping of US. That means dumping means what? Sell. And they are buying what? Gold. So when you're dumping US Treasury bonds, US Treasury bond prices are going to fall. Why? Too much is available. US Treasury bonds, prices are coming down. That means US bond yield should ideally increase. If the US bond yield is increasing, these bond yields are directly proportional to interest rates in the bank also. So when the bond yields are high, bank interest rates will also be higher. Bond yields are low, bank interest rates will also be lower. So there's a direct relationship between bond. Trump wants yields to be lower. But since everybody is dumping, Trump is not able to control the bond yields in the US market. And therefore, Trump is asking US banks like JP Morgan, you buy. He will not ask. He will command. He's saying, you buy, I don't know what. Okay, so you buy these bonds now and suck these bonds on the market. But beyond a point, banks cannot do that. It will affect their profitability. Just like that, they can't keep on buying. So this is what is the current discussion that is going on right now. I hope it is clear. I'll tell you in a simple manner. Here the coupon is nothing but interest. Okay, so coupon here is 10%. Okay, then that is 10%. Suppose the coupon is 15. That means interest rate is increasing. Okay, so if the interest rate is increasing, then automatically yields will also increase. That means interest rates and bond yields are directly proportional. GSEC is a coupon bond. No. Wait. This will come in UPSC. Treasury bills are zero coupon bonds, which is in the money market. Because when T-bills are issued, there is no coupon announced. These are discounted securities. That is what I mentioned. No, there is no coupon announced. GSEC, there is a coupon announced. There is an interest announced. There is interest announced on coupon. There is a coupon announced on GSECs. GSECs in the capital market are coupon bonds. Dated securities are coupon bonds. Treasury bills are non-coupon, zero coupon. Don't get confused. So, is that okay till here? Understood? Don't see, that will be asked. There you should not make mistakes. They may not ask about Trump. But that basic you should not do any mistakes. Otherwise, all the effort of current affairs will go waste. Is that clear? Understood? Right. So now let's go to a few bonds which you will read later. I will tell you. But here, first one, heard of green bonds? Green bonds. So what is a green bond? That means you're raising money for sustainable development, environment friendly logic. Okay. Is that okay? Green bonds generally, I'm asking you a general question. For green bonds, generally there will be high coupons or low coupons. High coupons. Remember this. Green bonds generally high coupons. Why? Because this fellow has to spend a lot of money in proving that it is environment friendly. Okay. Then why should I buy green bonds? You should be getting high interest. Okay. So here basically, see, green bonds interest rates will be low, not high. The logic is he has to spend a lot of money on getting sanction, permission, etc. So generally he will not give you higher coupon, he will give you lower coupon. That means lower interest. Then why should you buy? Maybe because you want to call yourself, morality aspect is also there. So you want to feel good. Like this. Okay, so nothing wrong, so green bond. But now why did I talk about green bond? There's a difference between green bond and transition bond. What is the difference between green bond and transition bond? Transition bonds are for those companies which were not there in green projects. They are in certain projects, like they're in cement industry. They're polluting the environment already, but they want to transition into green. Are you able to get this? They want to transition. Their core business is not about environment related aspect. Suppose there is some business which is purely environment related. Now you issue green bonds and raise money for your project. Okay, so your output directly is clearly stated. But suppose there is a cement industry or there is some manufacturing unit which is not about environment related unit. In fact, it pollutes also, for steel sector, cement sector. But you want them to slowly, and they are slowly transitioning into environment friendly. And for that, they are trying to raise money. Are you able to get this? This is basically called as transition bonds. That is the difference between green bond and transition bond. So here, to help hard to abate sectors raise capital for progressive decarbonization. Certain industries like this, they are moving towards decarbonization. For that purpose, they can raise something called as transition bonds. That means there will be a second review also. That means automatically it will not be allotted. Obviously, there will be some other entity which has to check second line verification for transition bonds. Because in the name of transition, you raise money, but you spend it on your cement industry. That's not the case. You have to move towards slowly something related to decarbonization. That is what is transition bond. Green bond, see, this is to prevent something called as greenwashing. What is the meaning of greenwashing? In India, it is very common. Okay, greenwashing. If you remove that green color, everything is brown. Everything is pollution. I think you got my point. So, but you are painting it as green and you want to raise funds. Okay, so in India, how CSR works, you know, corporate social responsibility. You're saying 2% of the profits you spend on environment, on welfare, on education, etc. That also they'll spend it in their friend's company only. And they'll claim CSR, corporate social responsibility. Most, not all, but this is also possible. So greenwashing is something like, you are actually projecting yourself as environment related, but it is what is greenwashing here. Enforced through transparency, disclosures, and third-party validation, ensuring investor confidence. Investor wants to invest in a green company, let's say. Somebody who's very environment focused. But most of the, you can't even find out whether this is a real green project or is it greenwashed. So now secondary checks, mitigation is very important. That is what is greenwashing. I hope it is clear. Understood, right? Additional tier 1 bonds. Okay, now first thing here. Always bonds here, if you see, what are the things that are there on a bond? One is you will have what is the price of the bond. Okay, then you will have what is the coupon or the interest on the bond. And then you will also have what is the maturity. When will this bond mature? But when you say perpetual bonds, these are bonds till perpetuity. Till perpetuity means no maturity. bonds till perpetuity. These are called as perpetual bonds. No maturity period. You keep on getting interest. Are you able to get this? These are called as perpetual bonds. The only concern in perpetual bond returns is, main concern is time value of money. You're getting, let's say 30 or 40 year also, but the time value of money becomes important. So suppose I'm getting every year 50,000, 20,000, 30,000, and you get that consistently. But the problem is that 30,000 may not be same as 30,000 today after 20 years. So this is called as time value. So you calculate like that. But perpetual bond means no maturity. Okay. Now additional tier 1 bonds, that is there. So who issues them? Banks generally. What is the purpose of issuing these bonds? To raise their tier 1 capital. Yesterday we talked about tier 1 capital. So tier 1 capital has the retained earnings of the company, equity of the company. Okay, and it can also have some capital which is raised through additional tier 1 bonds. That means that money which the bank is raising through these bonds, it can show it as part of tier 1 capital. That is why you're calling it as additional tier 1 bonds. These additional tier 1 bonds also are like perpetual bonds. They do not have what? Maturity period. They do not have maturity period. Are you able to get this? That does not mean these bonds are safe. These bonds are not for everybody. For example, Yes Bank came up with such kind of bonds, but RBI was very clear. You should clearly mention it is for whom. It is not for everybody, because any time the bank can call back this bond. Okay, so here basically any time the bank can call back. For example, here if you see, additional tier 1 bonds are also known as perpetual bonds. These bonds are issued by banks without any maturity date, but they have a call option. Now, what is the meaning of a call option? Are financial contracts that give the buyer the right but not obligation to buy a stock or bond. So that means any time, if required, the bank can call back that bond. That is the risk. Suppose RBI feels that this bank is not doing well, or this bank is hopeless. RBI is asking the bank to call back that particular bond. So there's a higher amount of risk involved. And even certain period of time, if they don't pay interest also, the investor cannot question. Are you able to get this? You can't question why are you not paying under certain critical circumstances. That is the reason these are basically risky bonds. And why is bank using this? Banks use these bonds to meet their capital adequacy requirement. Yesterday we talked about capital adequacy ratio, total capital divided by risk weighted asset. Is that okay? So go back and read Masala bond, rupee denominated bonds issued in other countries. Okay, so that you should know what are Masala bonds. Just see what are Maharaja bonds, they were in news long back. Okay, so and also see what are zero coupon. You know what is zero coupon now? Okay, so these are different types of bonds which are there. This you can read later. You go back and read this Payment Regulatory Board. Okay, simple only, just go back and. Yes, obviously. Okay, so rate of interest, otherwise what is the motivation? There's a motivation to buy these bonds, but there is a risk associated with it. Is that okay? Yes, let's move forward. Unified payment interface. So here are some facts here. Okay, so recent visit of Prime Minister, Namibia decided to sign a licensing agreement and become the first African country to adopt UPI system for real time. They was already asked this question. Got the point right? Okay, so which are the other countries who have accepted the UPI payment? This we have discussed in last year's PT. Okay, so that is something which, okay, now immediate money transfer through mobile device round clock, you know this already. Okay, so and NPCI incorporated in 2020 is deploying RuPay and UPI outside India. Countries where UPI based international merchant payments are accepted, including Bhutan, France, Mauritius, Nepal, Singapore, Sri Lanka and UAE. So already this was asked earlier. Okay, about NPCI. So factual later you can just see. Is this clear? Okay, now there are some more 2 words here. You can see one is about Bombay Stock Exchange. So along with this, I want you all to go back and see a few more words. One is demutualization related to Bombay Stock Exchange. Everything we can't discuss, but go back and see demutualization related to BSE, Bombay Stock Exchange. Okay, then check Sensex. Okay, Nifty is Nifty 50. These are what indices? Sensex is an index of what? BSE. Sensex is an index of BSE where there are 30 companies. You should know that there are 30 companies. Okay, so then there are 2 depositories which will go. There was a question already on CDSL. There are only 2 depositories in India. That means today we are buying shares in electronic format. Where are the shares kept? They are kept in depositories. What are the 2 depositories which we have? CDSL and NSDL. CDSL, there was a question. Of course, you can identify. Already there was a question in CDSL. Like who are the participants who have set up CDSL? So go back and check what is the CDSL, who are the participants. This is a previous question. Then also check NSDL. CDSL is also a listed entity. You know this? Okay, shares are traded. So CDSL, NSDL, you only have 2 depositories. Zerodha and all are depository participants. If you don't know about them also, it's okay. But you should know about the depositories. That is why UPSC is asking questions about CDSL and NSDL. I hope it is clear. Understood, right? Then also check details related to IPO. Check details means factual content related to IPO. That's again why, because consistently it is in news about primary markets. So you should know about IPO, FPO, etc. Basic, not calculation, basic. Okay. So this is 150 years of BSE and a native share and stockbrokers association in 1875. It is Asia's first and world's Okay. What is the fastest stock exchange? Okay. Okay. So BSE came. This became first listed stock exchange of India. Okay. So and Asia's largest stock exchange. Okay, it's Asia's largest stock exchange. So Bombay Stock Exchange, of course, it touched 85,000. So Sensex basically, Sensex, which is an index of, now of course it has fallen down because of Trump. It has come down drastically, but around 80 to 83,000. So for Sensex, the base year is 1978. Base year for Sensex is 1978. That means 1978 is indexed to 100. So today, if it is becoming 83,000, that means Sensex has increased by 830 times from 1978. Compared to 1978, Sensex has increased. That is the reason, if you observe, Sensex base years have not been changed. Generally, we keep changing the base years of GDP, keep changing the base years of CPI. Okay, so other indices, we keep changing the base years, but we have not changed the base years of Sensex because it gives you a correct picture as to how many times it has increased. So basically, 1978, when it was indexed to 100, today if it is 83,000, it means the Sensex has almost moved by 830 times. And Sensex is a index of BSE. Nifty 50 is an index of NSE. So you go back and read about Sensex, what is it? Okay, that's it. Now here, BSE is regulated by obviously SEBI, right? Okay. Now India's sovereign credit rating. First of all, sovereign credit rating will, see, individuals' credit rating is given by these entities like CIBIL. Similarly, institutional also have their credit ratings. Even countries can also have their credit ratings. Better is your rating, it indicates your credit worthiness. What is the meaning of credit worthy? You are credit worthy means you can take loans and you will not default. So you'll be able to raise money from the market at lower interest rates. As simple as that. If the credit ratings are bad, then it is difficult for you to raise loans. As simple as that. So here, if you see, S&P upgraded India's long-term sovereign credit rating and its short-term rating to A2 from A3 with a stable outlook. It indicates that we have become more stable in our credit outlook. It refers to an independent evaluation of a country's credit worthiness. Credit worthiness talks about you're worthy of taking credit or not. Worthy of taking credit, you can raise more credit. As simple as that. Is that okay? Yes. There are many other credit rating agencies. You have Moody, Fisher, Standard & Poor, etc. Okay. Okay, one more thing. You'll also check inverse ETF. Go back and check inverse ETF. ETF is what? Exchange trade fund. Can ETFs be sold in the stock exchange? Yes. Unlike mutual fund, these are exchange traded. Inverse ETF means when the market falls, you make money. Last year, madam was talking, SEBI madam last year, was talking about inverse ETF, still not implemented in India. So inverse ETF means regular ETF, gold ETF, gold price goes up, your ETF goes up. Inverse ETF, inverse gold ETF, suppose it's there, it's not there. If it is there, gold price goes down, your ETF value goes up. Reverse. That is what is called as inverse ETF. Mutual fund ETF, mutual funds are not traded in the stock exchange. ETFs are exchange traded. The word itself is exchange traded, means they're traded in the stock exchange. Every day you can sell it whenever you want. That is what is the basic difference. So go back and see what is that inverse ETF. Okay. Clear till there? Understood? Okay. That topic will a lot of words keep coming, but you stick on to whatever is coming in news regularly only. You can't read everything in capital markets. As simple as that. Concept should be clear. And current affairs, some bonds which are consistently in news only you will remember. That's it. Green bond, transition bonds, additional tier 1 bonds, masala bonds, previous year questions. That is it. Zero coupon bonds, okay, inflation index bonds. These are what were asked already, right? Yes. Now this is external sector. Okay. So when we talk about external sector, actually in the basic conceptual area, you should know about BOP. You should know about current account, capital account. You should know about exchange rates. You should know about J curve. You should know about rupee depreciation, appreciation, impacts of appreciation, depreciation. Then you should know about those things which are part of my capital account, including ADRs and GDRs. You should know about components of ECB. ECB is what? External commercial borrowing. You have to dig deeper. Huh? You should go back and see, it's not sufficient that you read what is ECB. You should see what are the entities which are part of ECB. You should know about external debt and the constituents of external debt. All this is, and then internationalization of rupee, then Vostro accounts. These are all, got the point, so much is there. So these are all something which you should definitely know to attempt questions in prelims. I'm talking about the static portion. I hope it is clear, right? So when we talk about external sector, when we use the word balance of payment, it is nothing but an accounting statement which records economic transactions of resident of India with rest of the world. Economic transactions of resident of India with rest of the world. I hope it is clear. Okay. Now the BOP account can be divided into current account and capital account. Okay. And what are the main components in the current account? The main components in the current account are trade, transfers, income, and services. I think you're able to get this. Trade, transfers means remittances also. Remittances, grants, trade, transfers, remittances, transfers of remittance, income, and services. What are the components in capital account? So capital account basically deals with assets and liabilities. Capital account basically deals with asset and liability. Today, Indian rupee is only partially convertible. It is fully convertible with respect to current account. and it is partially convertible with respect to capital account. That means with respect to those things which are there in my capital account, there are still restrictions and regulations still prevail. So what are the things which are there in my capital account? Capital account mainly has investments and borrowings. I hope it is clear. In the investment criteria category, you have 1 FDI, 2 FPI. You will get this. Okay, and you also have ADRs and GDRs. ADR is what? American Depository Receipts and Global Depository Receipts. I hope you're able to get this. Previous question was, which of the following is part of foreign direct investment? And there was one statement which was given, Global Depository Receipts. Are you able to get this? Okay, so which of the following is part of FDI? And they gave GDRs or Global Depository Receipts. So GDRs and ADRs are part of investment, first thing. Are you able to get this? But government and FEMA rules puts these GDRs and ADRs under FDI category. I'm again repeating. Government rules and FEMA rules put ADR and GDR under FDI category. RBI puts ADRs and GDRs under FPI category. No? Yes? What? Is that okay? So this is the basic background before we get into this topic. Okay, what I was trying to tell, see in the BOP, of course, we're not discussing it in detail. So here we have mentioned something like, one is we have put current account and another one is we have mentioned capital account. So as part of capital account, primarily we talk about borrowings and investments. So as part of investments, we talk about FDI and FPI. Okay, and here as part of borrowings, there is something called as ECB, which is the major portion of external debt. Major chunk of external debt is in the form of ECB, followed by NRI deposits. This was the previous question again. Major chunk of external debt is in the form of ECB. ECB is primarily private debt. ECB is primarily private debt. That means companies are borrowing from outside India for a long-term period. And then you have soft loans, which is called as external assistance. This is called a soft loan, right? Now, this is basic. So here, ADRs and GDRs are treated as part of FDI according to government rules of FDI. Government rules of FDI or FEMA rules put them under FDI classification. But whenever RBI is releasing FDI data, RBI will not take this under FDI. RBI considers them as part of FPI. So that statement where the previous question which was asked, which of the following can be part of FDI? You will find GDR is also part of FDI in the UPSC key. So GDR is part of FDI. This is according to whom? According to government or FEMA rules, it is part of FDI. RBI, whenever it releases data, RBI says we'll put this in FPI. I hope it is clear. So FPI can again be, you have FIs here, qualified foreign investors, etc. as part of portfolio investment category. Okay, now always there was a BOP crisis in 1991. This is because we did not have enough money in the current as well as capital account. So, and therefore we had to borrow from, or we first, whenever there is a crisis, you ask what? RBI. So, see, whenever FDI is coming into India, is it a credit or a debit in my BOP? Credit in my BOP. Is that okay? Suppose if Tata is acquiring some assets outside India, it is a debit in my BOP. So BOP always talks about credit and debit transactions. So credit and debit means it is all based on money moving in, money moving out. So for example, if there is BOP deficit also, if you are removing forex from here, this is called addition of forex. This is basically removal of forex from RBI's pocket and you are pushing into BOP. This is also nothing but what? Credit in my BOP account. Are you able to get this? If there is BOP deficit and you are removing money from RBI's pocket and pushing it into BOP account, this is also what? Credit in my BOP. Are you able to get this? Similarly, if there is surplus here, you are removing that surplus forex and pushing it into RBI's pocket. What is that? Debit. This is called as addition to forex reserve. Addition to forex reserve is also a debit in BOP account. Are you able to get this? So credit and debit. Why this discussion is because we'll talk about FDI. So one is we already know the basic understanding of foreign direct investment and foreign portfolio investment. Okay, so now Arvind Mayaram committee's recommendation is purely about control over the asset. So now the new definition is all about the control over the asset. Okay, so if you don't want to continue as FDI, then you can dilute your stake. You can dilute your stake, yes. So IDRs also, see IDRs and everything. So here when you talk about what is the mechanism of IDR? Who invests through IDR? No, what is the purpose of IDR? So in ADR, why ADR is there? See, there is something called as direct listing. What is the meaning of direct listing? Suppose Indian companies can directly list in US stock market. You don't need these depository receipts. Because the guidelines don't permit you to directly list there, you go to a depository in US. That depository can be a bank also. And that depository will analyze the shares of this Indian company and it is issuing some receipts in the US market in dollars. That is what is American depository receipts, in simple words. Is that okay? Same thing in the European markets, we are calling it as GDR. So IDR should be what? Reverse. Reverse means what? If a foreign company which cannot directly list itself in the Indian stock exchange, it's coming to a depository in India. Based on the valuation of the foreign shares, you are issuing IDRs. Okay, and these are issued in rupees. Yes. No, this is all ADRs. See, you will not have IDR coming in. Here basically you have ADRs and GDRs only because that is basically something that is coming in foreign money. Is that okay? Yes. Till here, is it clear? Okay. So this is the basic difference between foreign direct investment and foreign portfolio investment. For prelims, what becomes important here? Okay, so one is FDI is important because net FDI flows have reduced for India. Net. So what is the meaning of net? It is FDI inflow minus outflow. That means though there is inflow of FDI, still our net FDI has come down. This is because there is huge outflow of FDI. Are you able to get this? Why? What is this huge outflow of FDI? It can be foreign companies which are pulling out money from India, going back. That can be also outflow. Similarly, Indian companies going and investing abroad. That can also be outflow. Are you able to get this? Okay, so one important observation here is net FDI inflows fell by 96% in 2025 in comparison to 2024, despite increase in gross FDI inflows. That means this gross FDI inflows was increasing. If you see, this is about FDI inflows. You can see here, US $1 billion. You can see there is an increase of 14%. This is about FDI inflows. Everybody is able to get this. But when we look at net FDI inflow, it is basically there's a lot of money moving out of India. That is the reason when I compare net FDI, you find there is a huge amount of reduction in the net FDI. I hope it is clear. Is that okay? You can see net FDI inflows fell by 96%. Though you observe that FDI inflows are increasing. I hope it is clear, everybody. So that means first thing here, you should know what is the basic difference between total investment made by foreign entities directly into productive assets of India. That is what is gross FDI. Net is what? Difference between inward FDI inflows and outward FDI flows. That is what is net. But net has come down, but inward FDI inflows were there in India. So this is what is the observation from here. So for prelims, two things you will remember here. Okay, so one, net FDIs have come down. FDI inflows were increasing. Second thing, total FDI inflows that have come up, maximum have come up. You can see here services. Then you have computer, software and hardware, and then trading. This is the order basically. Are you able to get this? So here you have services, computer, software and hardware, and then trading. One more important observation, maximum FDI is coming from. Okay, so these two itself is touching almost 47%. Okay, and that is why the doubt comes whether it is really FDI. Got the point right? If money is coming from tax havens, the doubt comes, is it really FDI? Does Mauritius have so much of money that you're investing into India is the question. So the discussion of round tripping. So our own black money, is it getting rooted in the form of FDI through these countries like Mauritius and Singapore is the doubt. But maximum FDI India is receiving from which country? Singapore. Then followed by Mauritius. Sector-wise, service sector. And then here FDI inflows, are they increasing? Yes. FDI outflows have increased even more. That is the reason net FDI inflows have come down. This is what is understanding in the current. Okay. One more important observation here. This is something which you should be knowing already. So FDI can move into India through automatic route and non-automatic route, right? And non-automatic means government regulated route. So government regulated route means you need approvals of CCEA, Cabinet Committee on Economic Affairs. Even automatic route also, after coming into India, you have to inform to RBI, though you need not take permission. See, automatic route permission is not required, but intimation to RBI is required. Are you able to get this? Intimation is different from permission. Then you should also know which are the sectors where FDI is prohibited. That can be, no. So here if you see, FDI is prohibited in lottery, betting, gambling. FDI is prohibited in Nidhi companies and chit funds. See, Nidhi companies are those entities, for setting up a Nidhi company, you don't need RBI license. They're not regulated by RBI. What do these Nidhi companies do? The pooled money, they will lend among themselves only. They don't give loans to outsiders. Like NBFC. NBFC can give loans to outsiders. Nidhi companies don't give loans to outsiders. The members who are pooling money, they only take loans inside. These Nidhi companies also, FDI is not permitted. Okay, you can see here, betting, gambling, FDI is not permitted. Atomic energy, FDI is not permitted. Go back and read FDI into space. Go back and read what is FDI, how much FDI is coming into space. Okay, and whether it is coming through automatic route, whether it is coming through non-automatic route. For satellite manufacturing, etc., what is FDI limits? You have to go back and see that. Okay, FDI into space, go back and check. So here examples of FDI prohibited. So lottery, betting, gambling, and also chit funds, Nidhi companies. Okay, and sectors not open to private sector. Railway, it's not complete railways, but railway operations and atomic energy. Don't say defense. It should be, yes. Yes. Now, yes. It is non-automatic route. Yes. Till here, is it clear? Okay. Now, these are for prelims. Real estate also FDI is not permitted. Exceptions are there for that. Exceptions are, you're building infrastructure, you're building some road infrastructure or townships, then FDI is permitted. But otherwise, FDI into regular real estate, no. But there are exceptions there. Okay, so if real estate is an exception case. Exception means FDI is not permitted into regular real estate. But exceptions are building infrastructure, road or townships, etc. It is permitted. Okay, yes. Till here, I think it is clear, right? Now here, foreign portfolio investors. We know this. Okay, so Foreign portfolio investors are regulated by whom? SEBI. No confusion. They are regulated by SEBI. In the next class, you'll tell me who will regulate FDI. Very difficult question. Who will regulate FDI? Is there any regulatory body which regulates FDI? Investment per se, who regulates it? You tell me in the next class, tomorrow's class. Okay. So come back here. FPIs can hold a maximum of 10%, which we've already discussed. If you exceed that limit, then again you can divest it or reclassify yourself as FDI. But when you reclassify, again there will be sector-specific conditions. For example, the certain sectors FDI is not permitted. Similarly, there is something like upper limits with respect to how much FDI is permitted. So all these sector-specific conditions have to be adhered to when you are moving. Okay, is that clear? Then what is internationalization of rupee? What is the meaning of internationalization of rupee? You're asking, see, first of all, Indian rupee is not a hard currency. The meaning of hard currency is widely accepted currency. There are many reasons for that. Okay, so many reasons. That means international banks don't keep Indian rupee for transactions. If you go to Indonesia, you are on streets also, if you give them rupees, they'll say, we don't want, we want dollars. Okay, so that means acceptability of rupee is very less and limited. But at the same time, government is putting in a lot of efforts with respect to internationalization of rupee. So for which, what is government trying to do? One is, about masala bonds. Masala bonds is one mechanism of creating some demand for Indian rupees. Because these are rupee denominated bonds issued in other countries. That means somebody in other country wants to buy that, they have to buy rupees first. That means automatically you're creating demand for Indian rupee. So masala bond is one. Then we have signed some agreements with countries like UAE. We said when we do transactions for oil and other things, you please accept what? Rupees. All these are efforts towards moving ahead with something like internationalization of rupee or making other countries accept. Okay. Then there is something called as Vostro and Nostro account. Okay. So one is Vostro. Vostro is, here you can see VOSTRO. Okay. Nostro is NOSTRO. Okay. So what is this Vostro and Nostro in simple words? Suppose there is a Russian bank. Okay, this is a Russian bank. Okay, and you have SBI in India. Okay, so if this Russian bank is having an account in Indian bank, that means Russian bank account is with SBI. Okay, so what is this account for SBI? This is nothing but Vostro account of SBI, and this account will be maintained in rupees. So Vostro means your account in your account in, right? Nostro is something like, suppose it is Nostro is reverse. What is reverse here? Now SBI's account is there with this Russian bank, and let's say it is maintained in dollars or ruble. What is this for SBI? This is Nostro account of SBI. This is Vostro account of SBI. This is Vostro. The first one is Vostro account of SBI. The second one is Nostro account of SBI. So your account in my bank, my account in your bank. Simple logic. Your account in my bank. So here Russian bank's account in Indian bank, and this bank maintains this account in rupees. This is nothing but the Vostro account of SBI. Is that okay? Then SBI's account is there with Russian bank, and it is operated, let's say, in ruble or in dollars, whatever it is. Okay, so this is SBI's Nostro account. Is that okay? Understood? I'll not drag till 8:85 today. We'll leave you early. Okay. This is based on face expressions. There are too many words that have come up, so that is the reason. Okay. So come back here. Okay. So here, RBI has removed prior approval requirements for banks to open special Vostro accounts, speeding up rupee-based trade settlements and supporting internationalization of rupee. That means, for example, suppose there is an importer. He is importing some goods from Russia. Generally, he has to make payments in dollars. Of course, now ruble we generally not dollars. So instead of paying in dollars, suppose this importer has credited rupees in that Vostro account. Credited rupees in Vostro account. Is that okay? Now, whenever there is an exporter who is exporting something to Russia, let's say. Exporter who is exporting something to Russia. Okay. So now he has to get some payments. Now that payment, instead of paying him in dollars, dollar being transferred from there to here, from this account, already there are some rupees, it will be settled here in rupees only. Easy method of settling in rupees itself. So physically, there is no movement of dollars from here to there. Automatically settlement has been done in rupees. Are you able to get this here? So the importer, when he imported something from outside, he has to generally make payments in dollars, but he's making payment in rupees. But that rupees is not taken there. That rupees is credited in this SBI's Vostro account. Are you able to get this? Similarly, when the exporter has to receive some money, straight away you are crediting or debiting this account, this Vostro account, and making payment to him. So here basically you're not much dependent on this foreign currency called dollar. Are you able to get this? This is the benefit of this special Vostro account, where dependence on this foreign currency or dollar has been reduced. This is what it is saying. Is that okay, everybody? So here, if you see, so Special rupee Vostro account was introduced in 2022 to enable exporters and importers to invoice and settle trade in Indian rupees. That means you're settling the trade in Indian rupees only. Vostro refers to a foreign bank's account held in domestic bank in local currency. Russian bank account in SBI, which is maintained in rupees, is nothing but Vostro account. That is what we have discussed. Is that okay? Similarly, example here. Okay. So for importers, when an importer pays a foreign trader in rupees, the amount is credited to the Vostro account. Okay. For exporters, when an Indian exporter receives payment, money is deducted from the Vostro account and credited to the exporter's regular account. So everything has happened in rupees here because of the help of that Vostro account. Okay. Nostro refers to domestic bank's account held in a foreign bank in the currency of the overseas country. That means SBI's account in Russian bank maintained in ruble. This is nothing but the Nostro account of SBI. This is what we have discussed. Is that okay? Example, if an Indian bank holds an account in US bank, in US dollars, it is nothing but SBI's Nostro account. We said Russia, they're saying US. Nowadays, they're not liking US. Okay, so remove it from examples. Very dangerous country. Nostro account simplify the process of exchanging and trading in foreign currencies, example dollar, because here the transaction happened in rupees. Okay, so that is what is. So what is internationalization of currency? An international currency is a currency like the US dollar, euro, pound, yen, to some extent Chinese renminbi also. Okay, which is used for transaction between countries and beyond borders of the issuing nation. Just like domestic currency, it performs 3 functions. Okay, like every currency performs a medium of exchange, unit of account, store of value. So today some people keep saying dollar is the real money. All others are not money. This is what US also feels. All other currencies don't have value. It is only dollar that has value. All others are papers. They keep saying this. Internally they feel that also. They feel rupee. Rupee mein kama rahe to you are useless. Why? Because it is not real money. Whenever there is war, US see how did US accumulate gold during First World War and Second World War? Whenever there is war, currencies lose value. So if you want to buy arms, ammunition from US, you have to pay them in gold. Very simple. So whenever there is this kind of war, US used to sell. US creates wars, US sells all these equipments, machines, and accumulated gold. By 1945, US was sitting on huge chunks of gold. Of course, US also has gold mines also, but still, this is how US accumulated gold. And that is the reason in the Bretton Woods system, why dollar was linked to gold, why not euro, why not other currency? To link a currency with gold, you should first have huge amount of gold with you. And US was having huge amount of gold. One is reserves, second is accumulated gold during wars. And US was sitting on so much of that. Is how the Bretton Woods system when it started, which is the fixed exchange rate system, where US dollar was linked to gold and all other currencies were linked to US dollar. All other means most of the currencies. Tomorrow I'll talk about that. Most of the currencies were linked to US dollar. Now since demand, what is the meaning of linked? So whenever other countries bring dollars to the federal bank, they have to exchange it with equivalent amount of gold. This is what it is. So if you are storing dollar, it is as good as storing gold. That is how US currency started getting the reserve asset status or the reserve currency status. That's how everybody started storing dollar as a reserve in their pockets. And that's slowly. Trump says this, no. So I want the reserve asset status of my currency. And along with that, I also want the benefits of trade. Since it's a reserve asset, you can't devalue. It's a reserve asset which is kept by everybody. You can't keep on devaluing like the China devalued its yuan. Since my currency is a reserve asset, I can't keep on devaluing the currency. Devaluation, I think, not depreciation. So China is devaluing their currency to increase their exports, but I am not able to do that. Then how do I bring in parity? Tariffs. This is how Trump puts forward his viewpoint when it comes to logic of tariffs. Okay. So Indian rupee depreciated. One of the main reasons for depreciation is also trade deficits. You should also understand one more thing. Dollar in the last 1 year has become weak. In spite of that, our rupee value depreciated further with dollar. Now, madam can't say this. Like madam earlier used to make this statement that it is not Indian rupee depreciating, it is dollar appreciating. Madam used to make this statement. Now that statement is completely wrong this year. Why? Dollar went on depreciating. Dollar value depreciated with respect to other currencies, other liquid currencies. But with respect to dollar, Indian rupee went down more than 4.5%, indicating that rupee value depreciated to a greater extent in comparison to dollar weakening. Okay, so many reasons for that. One reason is also trade deficit. Then two, flight of FIIs and FDIs from India. You see that outflow which you have checked. So more outflow means more dollars are moving out of India. More foreign investors, FPIs moving out of stock market, more FDI outflows, more FPI outflows, as well as reduction in trade, increase in trade deficits. All this has led to rupee value depreciation in the recent past. I think it is clear. So this is how the logic of tariffs and all. And Indian rupee, if you want to achieve internationalization of currency, you also have to go ahead with complete capital account convertibility also. But Indian rupee is still not fully convertible. It is only partially convertible. It is fully convertible with respect to the transactions in the current account, but it is partially convertible with respect to those things that are part of my capital account. So capital account convertible, that means ECBs, there are restrictions. FDIs, there are restrictions even today. Okay, so that is what you should understand. That means there is some restriction from the government side which it comes when you're converting dollar into rupee or rupee into dollar with respect to those things which are part of my capital account. I hope it is clear. So as part, that is the reason today you see automatic route for FDIs for almost 90% plus of the items. That means government also is working towards complete convertibility, gradual complete convertibility. So there was one committee called Tharapur committee, which was talking about convertibility, capital account convertibility. That should be done in a gradual manner. This is what government is also doing. If you observe, you have started allowing FDI into space also. and several other sectors who started allowing foreign direct investment in through automatic route. Insurance sector also have increased the benchmark. So all this is what? You're slowly liberalizing those things which are part of my capital account. Setting up GIFT City, IFSC is also moved towards liberalization or capital account convertibility. Okay, so one homework is LRS scheme, liberalized remittances scheme. So what you will check? One, you will check how much can we remit outside. Okay, so suppose you can remit, let's say $250,000. You'll check how much you can remit outside, how much dollars can you send outward remittance. Okay, then you will also check LRS is applicable to current account transactions as well as capital account transactions. Both check that also. LRS is applicable to current account as well as capital account transactions. Is that okay? One more homework. You will go back and see what are the things which are there as part of who are eligible to raise ECB, who are eligible to raise external commercial borrowing. For example, even SIDB can also raise ECB. SIDB is what? Small Industries Development Bank of India, Exim Bank. So what are the entities which can raise ECB? Okay, and also check what are the components of ECB. For example, there's something called as trade credit. Trade credit. So if he's asking which of the following is part of external commercial borrowing, you should be knowing, because the UPS is already asked, like maximum external debt is coming in the form of ECB followed by NRI deposits. All that is already asked. So now what you'll go back and check, what are the things that are part of ECB? What are the different types of credit that will be in external commercial borrowing? One more word. What is direct listing? Direct listing. That means Indian companies, can they directly list in US stock exchange, like in NASDAQ or somewhere there outside? So direct listing, is it possible, etc. I hope it is clear. Understood? Okay. So we'll continue from here tomorrow. Because these are very difficult concepts. It will take some time. Stop here.